The Federal Reserve has done its job, we think, remarkably well.
There's no question that you want to be moving rates at least back towards a more neutral setting.
The Fed will still probably be looking for 2 cuts this year.
You have the Fed rate cuts helping those sectors of the economy that are very rate sensitive.
The economy is not going to slide into recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, waiting for Chair Powell.
I think you have a big cut because I don't think he can help but cutting. It's perfect for cutting. And the thing that he's hurting most is housing for people. But because we're doing well in everything, energy's way down, groceries are down, everything, almost everything is way down.
The President Donald Trump pushing for Fed Chair Jay Powell to go big as the US and China meets in Madrid to bring down the temperature. China is ruling that tech giant Nvidia has violated anti-monopoly laws. That headline sending that stock lower.
You know, you set it up perfectly. The big picture this week is the Fed meeting, whether they cut, how much they cut, they're going to cut, and then what they signal going forward. But right now, the here and now is how much is signal and how much is noise heading into day 2 of these meetings between China and the U.S. Is this truly China going after Nvidia for potentially anti-monopoly laws or even anti-dumping laws, although it has to come with a price cut, and I'm not sure how that factors in? Or is this them trying to get leverage and using the same tactics as the U.S. have used to try to get an upper hand to these negotiations?
The stock is down by 2.5%. I'm right there with you. The flexing outside of Madrid is what gets your attention. Not just this decision from Beijing this morning on Nvidia, but also the president over the weekend, ramping up the pressure on NATO members to essentially put more tariffs and sanctions on China and people consuming Russian crude.
Yeah, and this also, again, signal or noise. How much is this just punting to say, if you guys do this tall task, then we'll do this tall task, and that will actually get us more leverage against Russia, especially given the fact that Hungary and Viktor Orban has come out pretty vociferously against putting some of those sanctions and not buying Russian crude. At the same time, you could say this maybe is a new line in the sand. That sand tends to be pretty easy to shift over, so as we've seen before. But let's see where this goes.
For financial markets, this is the appetizer for the main event. The main course is on Wednesday. So we've got a decision, we've got the forecast, we've got the news conference, and we've got a central question. Can this Fed meet this market? Because this market has moved a lot in the last few months.
That was something that Mike Wilson over at Morgan Stanley was talking about, that the market is asking for, please do this quickly, do this as quickly as possible. And if they don't get that, do you get some sort of retrenchment in markets? My question is, how much does it matter? Ultimately, what is the composition of the Fed and how much are the dots fungible? Do we get the first descent on both a 50 basis point rate cut as well as maybe even a hike on one side and the other? The greatest amount of descent going back to 1988. Is Lisa Cook on the Fed when it comes to Wednesday? Who else is going to be signaled to be on the Fed? These are the big questions surrounding how much the market can really take signal from noise from the Fed this week.
It's a quiet start to a very, very busy week coming up later this week. Equity futures on the S&P just about positive by 0.1% and very close to all-time highs. Coming up this hour, we'll catch up with Calvasina of RBC on rising valuations. We'll speak to Terry Haines of Pangaea Policy as President Trump calls on the Fed to go big. And the former White House trade official Kalutkiewicz joins us on US-China trade talks. We begin this hour with stocks near record highs as investors bet on the first rate cut of 2025. Calvasina of RBC writing the following. Our worries have centred on elevated valuations and the tendency of September and October to be tough months for the S&P 500 performance over the past 5 years. Laurie joins us now for more. Laurie, good morning. Good to see you.
Good to see you too.
You've talked about Q3 risks for quite a while now. As we work our way through September and have a look at October, do you think there are some decisions that corporate America needs to make in the next few months?
It's been interesting because that last little tranche of earnings calls that happened for the 2Q reporting season, few analysts got brave enough to ask about 2026 outlooks, and companies pushed back and said it's way too early. I even saw one company were asked about tariff impacts next year specifically, and they wriggled out of that question very astutely. And I don't blame them. I think there's a lot that they've still, got to figure out. But I do think the conversation has taken a bit of a turn to understanding, okay, tariff impacts are starting to hit now. Are the mitigation strategies working? What's going on with inventories? How much demand was pulled forward? we've got a lot to work through right now. Not all of it pretty. In fact, most of it is probably not pretty. That doesn't mean it has to kind of derail us on a longer term view, but I do think it helps set us up for some chop after we've seen sentiment sink, which calls into question whether retail steps in and when valuations are struggling to make new highs.
How are you wrestling with the situation, the tension at the moment, offering some kind of insight into 2026, at the same time grappling with whatever C-suite strategy is actually going to be for the next few months and beyond?
I think the reality is that we know that it's a more uncertain environment than what we would prefer to have as forecasters. What I think we also did learn, though, in this last reporting season is that companies are doing a good job of managing through. Now, if you looked at the tariff-related sectors' anticipated operating margins for 3Q, as well as, kind of the realized ones for 2Q, did take a bit of a hit, right? So they weren't unscathed. I think that got it kind of obscured in the broader S&P because tech margins were so strong and those forecasts came up. But the reality is they are taking some hits. There's a little bit of wounding and scarring here, but they generally came out with very, very good results. And we know if we look back over time, earnings tend to stay flat in terms of forecast expectations versus what actually ends up happening in the second half of the year. So companies are really, really good at fighting through a couple of quarters. The question is going to be, what's their guidance for next year? The question, frankly, is also going to be, what do they do with mitigation strategies? We know they've done a lot of the easy stuff so far. We keep seeing this no regrets actions have been taken, things that can be easily undone. It might be time for harder decisions to be made.
So all of this doesn't answer the question that a lot of your clients want to know. Do I buy stocks, right? And so this is sort of the key question. You came out with this complete black box and you said 7,100 at the end of 2026. And people would say it sort of feels like throwing a dart at a dartboard. What's the point of you even putting something like that out?
Look, it seems way too early. And I think I was on one of your sister shows, a week and a half ago saying it's way too early. But the reality is I got out and started talking to clients last week in kind of the post, kind of Labor Day, kind of rush of marketing. And the reality is that people are, I would say there's a debate on the near term. Some people are bearish. I talked to a fair number of people last week who are bullish and thinks things are just going to rip. But the reality is the conversations turn quickly to the year ahead setup. And in our weekly, we always update our target models. So we felt like it's just time to sort of say, this is what they're signaling about the year ahead. We're going to have to keep revising them as we get closer to 2026. But the reality, if you look at AAII sentiment, it sunk like a stone in August. Short term, that has implications. In recent years, it's been a bit of a leading indicator for a short-term market decline. But from current levels, your average return over the next 12 months is 15%. So that, to me, sort of encapsulates the idea we have to work through some hard stuff. It probably gives us a bit of a liftoff and a little bit of a launch pad for next year. We're not quite there yet, but I do think, how do you use incremental weakness if it comes in? One, be prepared for it. Two, understand why it's happening. And three, think about how you use it for the longer term.
So let's talk about the hard stuff, because this week we're going to grapple with the hard stuff. Is the Fed cutting for the right reason or the wrong reason? Because they have to or because they can? And that's the question that Julie and Emmanuel put out there. What's your take on how much this has a potential this week and this Fed decision to be a disruptor in this trajectory of sort of steady gains that we've seen over the past couple of months?
So I can tell you basically since May, I've been hearing, sort of two or three things from my clients about, kind of the rally in stocks. And one of them has been Fed cuts are coming, Fed cuts are coming, Fed cuts are coming. So they're going to be here. My rate strategist says that some people in his world are still holding out hopes for 50. We're not in that camp at RBC. It's not something that's been pushed on me in my conversations, but there is that potential out there. And I think at a certain point, you have to sort of say, is it already baked in? I think that what is not baked in is the idea that we may actually end up needing these cuts. And whether you're looking at government sources, private sources, or even kind of combing through some of these breadcrumbs on earnings call, it does feel like labor is in a worse place than what people thought a few months ago.
Where do you think that leaves the trade at the moment, small caps, 6 weeks of gains?
I am fighting and fighting and fighting with people on this. I feel like every strategist, is out there right now trying to say, buy the small caps. I used to do this for a living. I spent 7 years of my life living and breathing this space, and I still talk a lot to the small cap PMs. So there are different investors, right, that you have to take into account. There's sort of your longer term, kind of high net worth retail private bank. They're looking for the next big long-term upcycle. My small cap PMs care about this issue because if we're in, kind of this small caps off to the races, they need to degrade the quality of their portfolios to outperform. And then we've got the hedge funds, who are making the bets on the Fed. they have a legitimate, sort of view on the Fed. We've seen them bid up, and we've seen since late 2023, anytime we kind of dial up Fed cut expectations, the hedge funds move in, they bid them up, and then we get to the other side, and they look around and they say, oh, the economy's not so great. Cuts are not the only thing that actually drives small cap leadership. Oh, the economy is stuck in this 1% to 2% rut, and then it fades. And that's what I'm worried about this time around, because if you look at sort of the economic tailwinds for small cap, you need jobs growth to be accelerating. I don't think we're getting that anytime soon. You need ISM manufacturing to be on an upswing. It's stuck in a rut, bouncing along the bottom. And GDP, whether I'm looking at consensus or Francis's views, we're in this 1% to 2% forecast range for the foreseeable future. So I see risk that it fades. I don't want to be underweight, but I really am pushing back against everyone who's kind of frothing at the mouth over this trade.
The epicenter of this, though, is that you and the team don't believe in the reacceleration story for 26.
I think that we are not seeing, I'm looking at 2027 forecasts now, and those are coming in at 2%. 1% to 2% is a challenging economic backdrop for stocks. And I watch not just the level of the consensus forecast, but whether it moves up. And it's trending up just a teeny tiny little bit, but we're still only getting to like 1.7% for this year and next year. I am enthused about the fact that ISM new orders finally broke into positive territory, which is good for the CapEx story. But I will tell you, I am not seeing a lot of companies on earnings calls going around saying that they're going to ramp up CapEx. And if you look back in 2018, CapEx growth peaked early in the year. It ramped up in 2017. So I'm hopeful there, but it's a show me story.
The optimist in me is clinging to the same thing. New orders in the ISMs for both manufacturing and services, but literally, Bramo, that is it. Outside of that, it's a real struggle to find anything else.
Yeah, the only positive thing has been earnings and actually how much companies have been increasing their earnings. And there's been a dissonance between that and the labor market picture. I just wonder, I was thinking about what Lori was saying, that 50 basis points almost seems to be of a cut, seems to be baked in. Baked in where? It's not baked into the Fed funds futures market. It's baked into equity valuations. And that is a dissonance that needs to get resolved this week.
Laurie, it's good to see you. Thanks for dropping by. Laurie Calvasina there of RBC, looking ahead to 2026 with a loose price target of 7,100 on the S&P 500 year and next year. Can I call it that? A loose price target?
Second half.
A loose second half target on the S&P 500 next year of 7,100. I've got that right now. All right. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's bring in Yahara Anand for more. Hey, Yahara.
Hi, John. President Donald Trump is expecting the Fed will make a jumbo rate cut this week. You heard the sound at the top of the show. Speaking to reporters on his way back to Washington last night, Trump said, "I think you have a big cut. It's perfect for cutting." Though the median estimate in a Bloomberg survey of economists is forecasting for just a 25 basis point reduction in rates. President Trump also said he's prepared to move ahead with major sanctions on Russian oil if NATO countries do the same. Many European nations have cut back or stopped purchasing oil from Russia, but several NATO allies, including Hungary, have blocked more stringent proposals by the EU to target Russia's energy sector. And shares of Nvidia are lower in the pre-market, falling 2.5% after China ruled the chip giant violated anti-monopoly laws related to its 2020 acquisition of Mellanox Technologies. The regulator will investigate further, but did not specify what remedies it would seek. It comes as U.S. and Chinese officials head into a second day of trade and economic negotiations in Madrid. That's your Bloomberg Brief. John?
Yahara, thank you. Let's just call it convenient timing for that to come out this morning. Up next on the program, the president pushing the Fed to go big.
I think you have a big cut because I don't think he can help but cutting. It's perfect for cutting. And the thing that he's hurting most is housing for people, but because we're doing well and everything.
That conversation up next with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. The main event just 2 days away this coming Wednesday, the Federal Reserve decision, waiting for this Fed to cut interest rates for the first time for 2025. Going into it, your scores look like this, very close to all-time highs on the S&P 500. Equity futures are by 0.1%. This from Stuart Kaiser of Citi over the weekend. Rates pricing sets a high bar for dovish commentary, while equity markets near an all-time high set a low bar for growth to disappoint. That's the tension of the moment.
The tension, as Lori Calvasina was saying, the 50 basis points of a rate cut seems to be baked in, at least into equity valuations. While bond markets are raising some questions, is the tension of how they really justify cutting big at a time where inflation is anything but quiet.
Stocks up again this morning. Under surveillance, the president pushing the Fed to go big.
I think you have a big cut because I don't think he can help but cutting. It's perfect for cutting. And the thing that he's hurting the most is housing for people. But because we're doing well and everything, energy's way down, groceries are down, everything, almost everything is way down. But housing, because of the Fed, is not what it should be.
So here's the latest this morning. President Donald Trump expecting a big cut from the Federal Reserve on Wednesday following months and months of pressure. The central bank likely to ease policy for the first time in 9 months. Bloomberg's Tyler Kendall joins us now with the latest. Good morning, Tyler.
Hey, John. Good morning. So unsurprising comments from President Trump, since we know he's been advocating for this. And he could have an advocate at the table come Wednesday. And that's because a senior aide to Senate Republicans tell me that they're going to kick it into overdrive to get Stephen Myron's confirmation done by tonight. There's a few different procedural things that have to happen first. But at 5:30 p.m. Eastern, the Senate's going to open debate on Myron's nomination. That's going to last about 2 hours, which means at this point we're tracking a final confirmation vote around 8 p.m. Eastern. And at this point, Republicans seem pretty confident they can only afford to lose 4 GOP votes. And at this point, it doesn't look like Myron's really going to lose any. Now, of course, this comes at this moment of unprecedented political tension for the central bank. And as you said, the Fed is widely expected to cut. But the two big questions become, one, as President Trump framed it, by how much, and two, whether or not this kicks off a rate cutting cycle. And as President Trump says that he wants to see a big cut, it's likely that Myron could be looking for 50 basis points if he has a seat at the table. But as our analysts at Bloomberg Economics point out, divisions among Fed officials about the way forward here could open the door for multiple dissents at this meeting. And John, while it looks likely that Myron will have a seat at the table, one of the big questions still is whether or not Fed Governor Lisa Cook will too. As of now, a judge says that she should retain her seat, while the broader question of her firing plays out in court. But I'll point out that the Trump administration has asked an appeals court to rule by today on its appeal to that decision.
Look out for the latest news later this morning. Tyler, stay close. We'll catch up with you in the next hour or so. That's been the question over the last month, I think, on Wall Street. Not whether they cut. Been a conversation about whether it's 25 or 50. But who's going to be sitting around the table in the next 48 hours?
Given the fact that there is this rush attempt to try to get both Lisa Cook as well as Stephen Myron off and on the board, respectively, to try to change the composition. Just to put this into perspective, to give you a sense of how long it's been with consensus on the Fed. Yes, we saw those dissents at the last meeting, but this has the potential to be the first Fed meeting with 3 governor dissents going back to 1988. You could have people saying we should cut by 50 basis points, and you could get someone saying, I'm really concerned about inflation. We should put a hike back on the table. You could get both of those things in the same meeting at a time where the market's saying, please just say you're going to cut to zero.
Yeah, and I'm with you. I don't think that speaks to the politics. I think that speaks to how uncertain the economics are. And that's a very, very different view of what's happening at the moment.
This is the reason why you're not seeing inflation expectations surge on the long term. Maybe you can point to one thing that you think looks like a political survey, but other people point to the break-even rates in markets and say, it doesn't seem like there's really this runaway inflation. So if there really was this feeling that this was a politically motivated Fed, you'd expect a little bit more of that.
Terry Haines of Pangaea Policy joins us now to extend the conversation. Terry, good morning and welcome back to the programme. It's good to see you as always. Is it easier from your standpoint to say who will be around the table tomorrow when that 2-day meeting begins, or who won't be around the table?
Oh, I think you've got a situation here where both Cook and Myron are probably around the table. Sure, do they have influence? Probably not. In fact, the squawkier Myron gets, I think the less independent he looks as a governor, considering that the Senate is preparing to confirm him as somebody who's on leave from the White House.
At this point, there's a real question around how long Republicans can kind of coalesce around each other and continue to push forward President Trump's agenda. You expect this to be very concrete, at least here in the Fed nominees and potentially Stephen Myron's confirmation later today. How about when it comes to the fight over the budget? How about when it comes to some of the other agenda items that the president has?
Well, I think so on spending, what the Republicans are very interested in doing is very different than what the Democrats are interested in doing, which is why I've been saying for a month on your air that I think a shutdown is very, very likely. What Republicans want to do, among other things, is show markets that they're interested in being responsible on debt and deficit, and they're also interested in showing markets that it's New York, right? Is that it's New Yorkers, Schumer and Jeffries, that are interested in not interested in reining in debt and deficit. So there's that. What Democrats need apparently is some sort of demonstration to their base that they're willing to fight the bad orange man. And so there will be, I think, at least a short-term performative shutdown. But Leader Schumer has been very deft in the past over, letting people kind of shut down the government, letting his colleagues go, and then saying privately, see, this doesn't work, let's get back to the table, and so the shutdown ends. But, that debt and deficit problem is real.
I'm just wondering how much the Fed cutting rates aggressively or signaling that offsets some of the political turmoil, how much this is not necessarily just parallel lines of thought, but actually connected in some level.
Well, they are. I expect that the Congress expects, like everybody else expects, there's going to be a rate cut of some kind. And, as even the Fed has been saying for months, there's likely to be more than one rate cut. So they'll anticipate that. That takes some pressure off the debt and deficit matter, and since markets, particularly bond markets, have found a newfound affection for tariffs, the fact that tariffs are very likely to remain in one form or another provides another safety valve there. But paradoxically, that also allows more opportunity for performative political playing around rather than less.
Let's talk about some theatre, Terry, and let's keep it on trade. So this morning, we've got the Chinese regulator going after Nvidia. Over the weekend, the president's going after NATO, pushing them to put tariffs on people who buy Russian crude, China. And Terry, I just wonder what you make of the talks happening in Madrid, whether the real performance is taking place elsewhere.
Well, I wrote for markets yesterday that markets will consider the talk, the continued engagement, a plus, but they really ought to consider it as being a minus, because it won't amount to anything more than delay meaningfully on either trade or geopolitics. The signal from China is geopolitically, particularly, has been very, very clear. If you're Russia gets a whole lot more aggressive after the Alaska summit, in part as a result of new energy deals from China to prop up its economy. You have your answer there. And I've been saying for quite a while that the whole chip thing has been a rope-a-dope on China, basically to embarrass the United States. They say they want it. Then when they get it, they claim there's going to be security backdoors and newfound antitrust allegations. So I think that tells you everything you want to know about whether or not China is actually interested in doing a broader deal, either on trade or geopolitically.
So Terry, what do you think we are addressing in the Spanish capital?
I think this is a clear case of Churchill's jaw is better than war. We might as well engage them, because why not? But I think at the same time, there's less belief in this White House than there were in prior White Houses that talks like this can really lead to much of anything. I think what the Chinese are likely to do is provide some small win for the United States, and there's a lot of talk in the Chinese press about trying to do whatever they can to get Trump to come to China and meet with Xi Jinping, in part because they want the optics that Trump is going to China to meet with Xi Jinping.
Terry Haines of Pangaea Policy. Terry, always appreciate your take. Thank you, sir. This market moved on from this China story a long, long time ago. Doesn't really care about the news coming out of Madrid. What it does care about is escalation risk. And so long as we don't get escalation, that's okay.
The issue is rare earth metals and how much they can continue to go into the United States, how much there can be an ongoing volume of essential trade that continues between the U.S. and China. And all of this seems to be theatrics about getting the upper hand while maintaining that basic amount of trade. And that it really is all the market cares about.
We've got some movers to get through, not just Nvidia, but Tesla. The CEO, Elon Musk, in a filing buying over 2.5 million shares. That stock is up this morning in the pre-market by 4.5%. Up next on the program, we'll catch up with the former White House trade official Kate Kalutkiewicz on US-China trade talks in Madrid. Snapped a 4-day winning streak on the S&P 500 in Friday's session, but only just on the Nasdaq, an 8-day run of gains. The longest stretch on the Nasdaq 100 going back to August of last year. This morning, up again by just 0.05%. That's the equity story. Switch at the board and get to the bond market. A sneaky rally in the 10-year bond yield, outperforming the front end in last week's trading sessions. Now, this is for a second straight week. We have seen a flattening of the curve. The 10-year this morning, yields down by, let's call it a basis point, to 4.05%. 4 weeks of falling yields on a 10-year bond. That's the longest stretch going back to February. That gets my attention.
Especially because the two stories you just mentioned, which is potentially, if we get another day of gains, the longest winning streak on the NASDAQ going back to 2023, versus the rally in the bond market, which suggests maybe a greater degree of weakness, don't go together. There is a question of what is behind a rally in the 10-year Treasury yield, given the fact that the Fed controls the front end. It doesn't control the long end, at least not yet. So there's a real question going forward about what it is saying about the trajectory for growth.
So it's bad news if bonds sell off, and it's bad news if they rally too at the long end of the curve. Is that what we're saying?
Why? I mean, if you really think that there's an infusion of cash into the Treasury Department and then yields are going lower, or that inflation's been absolutely stomped out, well, then that's a great story, but that doesn't seem to cohere with what we're seeing in the data, at least in the past week.
30-year bond yields near 5%, no good.
Okay, come on.
467, no good.
It's not that I'm saying no good. I'm saying that the stories are somewhat in conflict, and that I suggest maybe let's wait and see what happens, if this is a head fake or if this is actually a real trend.
So bad news in the economy, good news for bonds. And I think that's the good news, that bonds are behaving the way bonds should. Because the worry was going into a downturn that maybe even with bad economic data, these bonds wouldn't rally. I don't know if that changes in the months to come. It's just an observation about the performance of the last 4 weeks. And I think that speaks to a better picture for the risk mitigation characteristics of fixed income in America.
If you still believe that bonds are a haven asset, this is absolutely the best news you could possibly get, because it suggests that continues to be the way things are.
That's, of course, a big if, and I'm right there with you on that debate. That is a big if still.
I don't mean to be skeptical, this morning.
We welcome it. It's our brand.
Oh, okay.
It's what we want. Let's stock some bonds for you. Let's get back to single names with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. It's a push and pull in the Mag 7 today. NVIDIA versus Tesla. I'll get to Tesla and that breaking news in just a moment. But starting with the decline in NVIDIA this morning, down 2.5%, with China targeting the company over anti-monopoly charges over a 2020 purchase of Mellanox. That's a networking geared chip maker. So it will be launching that investigation, of course, comes on the heels of that high-profile meeting in Madrid between Chinese and U.S. officials. It doesn't just stop at NVIDIA. Also moving this morning, you have other chip makers like Texas Instruments and Analog Devices, and that's because China also launching an anti-dumping investigation over analog chips. Again, these two companies make those exact kinds of chips, hence the declines this morning. Also comes off the back of on Friday of the U.S. adding 32 Chinese companies to its entity list. Finally, I mentioned Tesla, this breaking just moments ago, a filing showing that on September 12th on Friday, Elon Musk purchased $2.5 billion of shares. That equates to about $1 billion. The last time we saw any big action from Elon Musk was in 2022, but then he was selling Tesla shares in order to fund his purchase of Twitter. This morning, he is buying shares up 6.7%, John.
Danny with the latest. Danny, thank you. Tesla absolutely flying. More from Danny in the next hour. On our radar this morning, President Donald Trump pushing for a big cut. Trump hoping Fed Chair Jay Powell delivers a cut larger than 25 basis points and a dovish forecast on Wednesday. The Fed expected to ease policy for the first time in 9 months. Elsewhere, President Trump looking to turn up the pressure on Russia. Trump announcing on Truth Social over the weekend he's prepared to move ahead with major sanctions on Russian crude if all NATO nations agree to do the same and stop buying oil from the country. And finally, NVIDIA under pressure, as Danny pointed out. China ruling the chip giant violated anti-monopoly laws. The decision following an investigation into the firm's 2020 acquisition of a networking gear maker.
You put this all together, and I think we were talking about it earlier, signal noise. How much is this just theater and theatrics to benefit potential trade counterparties versus reality? It's very hard to know, because with China and the U.S., there's an ultimate existential question, which is, what is the goal? We don't have a sense. For markets, the goal is just keep things relatively normal, keep things going. And as long as you guys keep talking and having theatrics, I think it's okay. With NVIDIA, there's a potential tail risk. With Russia, frankly, it's almost a bigger story to me right now, more imminently, because it's unclear what could potentially stop Vladimir Putin from going harder after Ukraine if some of these threats don't materialize in the near term.
Both sides are buying time in Madrid. And in the background, some really important developments are taking place. The US is putting even more pressure on their European partners, ultimately putting the ball back in their court to say that if you want us to go harder on Russia, you need to join in and go hard on the buys of Russian crude. And essentially that's India and that's China. They're the two countries in focus at the moment. And China's the bigger piece of the puzzle. Are the Europeans willing to sacrifice the economic relationship they have with the Chinese to make sure they continue to get the security they need from the United States? And the president is forcing them to make a decision with this push over the weekend.
Yeah, but it's really hard because the European Union doesn't act as one. And you have the likes of Hungary and Viktor Orban, who has come out vociferously against instating greater degrees of sanctions and continues to buy Russian crude. And there comes a sort of chicken and egg question where Europe feels like, well, if U.S. isn't going to be a reliable trade partner, why should we throw all our eggs in that basket? And the U.S. is saying, well, if Europe isn't going to step up, why should we be out here alone, potentially torpedoing our chances at trade deals with China and India? This was the goal of Vladimir Putin, was to split the West. And that essentially seems to be on the peripheries what's happening, at least in some of these trade negotiations.
In a much bigger way more recently, that's for sure. Let's stick with China and the recent trade negotiations. The US and China engaging in a second day of talks in Madrid. The president saying the talks are going just fine.
We've hit them very hard in so many other ways. I don't know if you know. Do you know what they're paying right now? What are they paying right now? You know what China's paying right now in tariffs? A lot.
Joining us now, the former Trump White House trade official, Kate Kalutkiewicz. Kate, welcome back to the programme. I want to pair the talks in Madrid with the developments over NVIDIA and whether you believe that's just convenient timing or deliberate timing.
Probably both. I think it's very deliberate on the part of the Chinese to try to keep some pressure on the Americans as they go into these trade negotiations, which, of course, were assumed to be discussions only with the Treasury Secretary, Scott Bessent. But over the weekend, USTR Ambassador Jamieson Greer joined him, which tells me that there's a bit more on the table than we had initially expected.
Kate, what do you think the goal of the talks are there? What do you think is on the table? What's the ultimate ambition, objective of things?
Well, U.S. officials are signaling that TikTok seems to be the primary goal here, which is a bit out of left field since it hasn't been as front and center as it once was. That indicates to me they're setting standards somewhat low. I mean, I think the goal here is to continue talking and to continue trickling along while, the Trump administration starts to create a front against China with allies around the world. So the goal, keep China at the table, don't let things escalate, but under the table, both sides continue to push below the belt.
And this really, Kate, is the reason why some people are pointing to the moves on NVIDIA as theatrics. It's almost like saying, hey, U.S., guess what you're doing? You're talking about both anti-dumping and you're talking about national security. We can do that, too. I mean, how much is this just essentially a performative act to give a sense of the conflicting goals on both sides?
Well, I completely agree with you. It's extremely performative, not least of all because the Chinese seemingly really were desperate for NVIDIA. Trump gave them NVIDIA. And then what happens? They say, we don't really want it. And also, we're going to accuse them of this anti-monopoly action. So, what a waste of time, frankly, to be this performative. But this is where we are in this relationship.
There's a question about leverage, and we were asking about whether this potentially could give China more leverage. I wonder where we're coming from. We got a slew of data overnight from China showing that the economy slowed more than expected, raising the specter for more stimulus, raising concerns that maybe there could be domestic blowback should this continue. How much do you think that that's affecting the landscape heading into these talks and heading into some of the deadlines that we're going to get in the fall?
Well, I think, of course, it's in the backdrop for China, and the United States is reading those reports as well and probably making them feel a bit more emboldened, particularly in its quest to get countries around the world to join it in imposing these very high tariffs on China. So I think, at the end of the day, the United States is still beholden to China when it comes to things like rare earths. But I think at the moment, if I had to guess, our negotiators are feeling pretty good in that room, that they don't have to give in in, that they can keep the status quo, that they can achieve some sort of outcome on TikTok and keep this relationship stumbling along.
Okay, can you explain to me what on earth is going on with TikTok? So this is what we heard from a senior official about 40 minutes ago. The Chinese officials arrived at talks in Madrid with a fundamental misunderstanding of the government position on TikTok, that the president is willing to let the TikTok ban go into effect, according to this official, and that China wants to tie trade demands to a TikTok deal at the same time the US wants to keep both topics separate. What do you think we are achieving? What's the breakthrough?
Well, I'm not, we have much lower standards now for breakthroughs these days, of course, which is just calm and delay and push. I think an outcome on TikTok, which enables both sides to say, we're going to continue to work on the interests of both sides, allow TikTok to remain in place. I mean, the president, of course, said over the weekend he doesn't care, but that's his usual negotiating stance. Commerce Secretary Lutnick last week in a fairly huge interview said the president cares very much about TikTok because young people care about TikTok. So the outcome is probably going to be status quo, and I suspect both sides will seek to say that that was a success for their side.
Okay, before you go, forgive me for asking this question, but why has this proven so difficult to deal with? The Chinese are very clear about US social media platforms operating there. Most of them don't. Why are we struggling to do the same thing here in America?
TikTok is one of those things that has really befuddled multiple administrations. And we are in such a strange situation here where Congress has actually banned the media app here. And President Trump has made this somewhat shocking decision to allow it to continue. But I think it shows the power of the app with a very important electorate that neither side wants to give up here. And China, recognizing that power, I think continues to hold on to it. In other cases, would happily sell. But it has just become emblematic, I think, of this push and pull over some issue that doesn't seem to be that important to the American people.
Kate, appreciate it. Kate Kalutkiewicz there, the former White House trade official. You talk about splitting the West. Talk about splitting the US over TikTok. We've got this tug of war that neither this administration or the previous one can seemingly address between the national security concerns around this app and the popularity of it with the general public. The general public, if you polled them right now, would tell you they don't really care about what's happening with this app or what's behind it or the concerns at a national security level.
Who are you talking about with the public? The young people. And that's what President Trump had to say. I want to do it for the young people. And they supported me in the election. And I did a lot of great work there. So there's sort of this confluence of politicians trying to reach out to young people on TikTok while also condemning the potential national security concerns. It can get your mind in a tizzy, which is the reason why we're seeing such conflicting messages.
Unexpected, but this has turned out to be a major topic of conversation in Madrid on day 2 of talks in Madrid, Spain, between the US and China. Let's get you the latest on news elsewhere with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Staying on China, its economy slowed more than expected in August. Retail sales grew 3.4% on year, down from 3.7% the previous month. Plus, industrial output and consumption had their worst month so far this year. The underperformance puts more pressure on Chinese negotiators holding trade talks with the U.S. this week in Madrid. Meanwhile, the U.S. has expressed regret over the detention of hundreds of South Korean workers. Speaking in Seoul, Deputy Secretary of State Christopher Landau says the workers will face no disadvantage when re-entering the U.S. Over 300 South Koreans returned home on Friday on a charter jet after being swept up in a raid carried out by U.S. immigration officials at a Hyundai plant. And Tesla shares are rising 5.5% in the pre-market. CEO Elon Musk is doubling down on his own company. According to a company filing, Musk purchased over 2.5 million shares of Tesla, worth roughly $1 billion on Friday. That's your Bloomberg Brief. John?
Big move for that stock. Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, betting on a rate-cutting cycle.
I do think that these Fed cuts are getting increasingly priced in. I think that is part of the story of what is supposed to get the economy moving a little bit faster.
A conversation up next with Christian Nolting of Deutsche Bank Private Bank. Live from New York City, you're watching Bloomberg TV. Stocks bouncing back from Friday's very mild losses. We're positive this morning, buying 0.14% on the S&P, just about unchanged on the Nasdaq. Under surveillance this morning, we're betting on a rate-cutting cycle.
Equity market, I think, definitely thinks that there will be this reacceleration in the economy. Not as clear to me that the rates market is sold on that, which is part of why we're pricing in these cuts in the rates markets. I do think that these Fed cuts are getting increasingly priced in. I think that is part of the story of what is supposed to get the economy moving a little bit faster.
So here's the latest this morning. Traders raising bets the Federal Reserve will deliver a string of interest rate cuts, starting with 25 basis points on Wednesday. Christian Nolting, the Global Chief Investment Officer at Deutsche Bank Private Bank, writing, with inflation appearing contained and labour market cracks emerging, the Fed is bound to pivot from its cautious stance and begin easing in September. Christian joins us now for more. Christian, welcome back to the programme, sir. I think we all understand they'll be cutting interest rates on Wednesday. All looking for that 25 basis point reduction. Christian, the question we've all got is what happens after that? What are they allowed, what can they ultimately forecast and guide to for 2026?
Yeah, so I think we all agree on this probably cut. So the question is 25 or 50. I would be really in the camp of 25, because why would you surprise the market, to be very honest? And if you go for 50 this time, I would say the market could also argue, do they know more about the labor market? Is it weaker than expected? So I think it's 25. And then, as you rightly say, there's more to come. I think there's room for the Fed to cut. We would expect over the next 12 months, way into 26, as you're saying, we expect 5 cuts, so a bit less than the market, because we think there's still some inflation pressure, not massively going higher. But I would say it's 5 cuts over the next 12 months. And the market is, if I look at Bloomberg, 6 cuts.
Christian, forgive me for getting stuck in some of the small print, but I think we've got to. We'll all go to the summary of economic projections on Wednesday that gets delivered alongside the statement. And in that, at the moment, for 2025, they've got unemployment for year-end at 4.5%. And I'm just wondering how much has actually changed for a lot of people on the committee looking at the labour market. They don't forecast payrolls. They have to forecast unemployment. Has that picture changed that much?
Yeah, I agree, right? It still looks very close to being at, say, full employment in the US. But I think if you look at the trend, it's weakening a little bit. I'm not saying it's massively going higher. But I think what the market is also pricing is the Fed is doing something, not a recession, but they want to cut now. And from that perspective, that should be positive for the economy. And from that perspective, yes, we don't talk. And that's the big difference, Jonathan, to other cycles. Normally you cut into a fiat recession. That's not the case. And that's one reason why we say it's probably only 5 cuts, still a lot from my point of view, compared to the market, who is maybe saying 6 or even more.
Christian, from an investment standpoint, does this make you more willing to go into U.S. assets because of the prospect potentially of faster growth, or flee because of the potential for faster inflation?
I think if you look at this year, 2025, it's very interesting. So it started with, being here in Europe, with a nice outperformance of Europe for the first time in many years, I would say. That has changed in the second quarter, where the US came back. It's a lot about, of course, technology, AI in the US. I think that doesn't change. From my point of view, I'm not fleeing US equities at all. My question is rather, do we see a change in Europe? And maybe there's more room for upside in Europe as well. Because if you look at rate cuts, which are anticipated, which normally is good for the market, if you look at earnings in the US, quite decent, right? Up 8% expected for 2025. And Europe is down 1%. And we do still hope for and expect some fiscal spending, maybe coming from Germany. And there's a lot of debate in Parliament this week. So maybe you see some results, and that could be also positive for Europe, not only for the US.
Hope doesn't necessarily, though, get the returns. And I am wondering how much you're seeing people double down on this Europe bet at a time where the US potentially could grow a lot faster because of rate cuts. And then you've got France getting downgraded over the weekend. You have, yes, this potential spend by Germany, but even the ECB is talking about a 1%, 1.3% growth rate over the next number of years. Are you suggesting clients double down on that European story, or are you saying, let's just hold out, watch, and keep hoping?
I would say we suggest to double down on Europe, because we do expect fiscal spending. I agree the absolute number, 1.3, 1.2% growth, doesn't sound very compelling. But if you think of the potential growth in Europe, it's roughly 0.4%, much lower than the US, by the way. And maybe you can bring this a little bit up with fiscal spending. I think there is room for performance. And as we see, Europe is clearly underinvested in many, many client portfolios from the US, from the rest of the world, from Asia. And interestingly, I get a lot of requests to explain about euro. And normally that comes with some money, which is then invested later, but it needs a trigger. And I would say now debates on fiscal spending, especially from Germany, could be a trigger that this gets more intention, and that probably could lead to some money flows as well.
Christian, language is important. You said especially from Germany. Is it exclusively from Germany?
I think most is coming from Germany, because obviously in France there's not so much room. Yeah, I would say look at Germany first, but it's the largest economy in the European Union. So from that perspective, I would expect some money to go into Germany, because that should be in the news with the budget discussions this week and next week as well. So from that perspective, maybe start with Germany. That's what we also tell the clients.
Who and what do you think benefits from that fiscal spending in Germany? We've already seen a monster rally in the European banks earlier this year.
Yeah, if you look from that perspective, right, so here the picture is a bit different, right? We do expect from the ECB not as many cuts as we do expect from the Fed. Max of 1, where if at all, so it's a lower level, of course, ECB being at 2%, Fed much higher, of course. But if you look, we still have some inflationary pressures, not too much, but there's still a steep curve, and that's positive for financials. So that call we made quite some time ago is still on. From that perspective, we think it's quite interesting to still look into this. And many banks are still trading below book value. So from that perspective, it remains quite interesting given the interest rate environment we are in here in Europe.
That's the medium term. This week, I'm curious about the reaction function in markets. If we do get a signal from the Fed that they're going to cut more steeply, do you go out and buy gold?
We have already a lot of gold in the portfolios, to be very honest. I still like it. Our forecast, also to give you a number, is 3,800. So up from here again. It has been quite a call, because there's so much discussions which currency you want to invest in. Of course, dollar, but everything in euro, probably also not everything in renminbi. No, that's why people look into buying gold. We think that's continuing. Central banks are buying gold, but also retail investors are looking into this. I think the trend will continue. But we have already quite a portion of gold and enjoying quite a nice rally. But as I said, we think that could continue as well, with our forecast being 3,800.
Underlying that question is this question about government bonds and just the developed markets, whether they still count as the haven asset. Do you view the rally that we've seen in long-term bonds, particularly in the United States, not necessarily in Europe, as reaffirming this quality of the securities at a time where there have been a lot of questions?
Yeah, I think it's quite interesting. I've just discussed with a lot of clients that also if you look at corporates, that's quite interesting, right? Look at the size of some corporates and then the discussions about higher debt levels. What's quite interesting for me, what we have seen is US yields not moving higher. In Europe, you have seen some yields moving higher also in Asia. So there seems to be a lot of discussion about the US government bonds, but maybe at one point in time, I think if yields were to go higher, maybe some Fed action can also be expected. On the other hand, if you look at Europe, France, of course, moving higher, better today, but there was also a downgrade. So I think, yes, it's still an anchor, but I think clients should also take into account the power of a lot of corporate bonds. And from that perspective, investment-grade corporate bonds, I think, is a very important trade clients should also debate.
Christian, enjoyed this. It's good to get your thoughts. Christian Nolting there of Deutsche Bank Private Bank. He likes what's happening with investment-grade credit, likes gold, and likes Europe, and thinks investors should be having another look and maybe doubling down. We've had a 60% move in European banks on the Euro Stoxx 50 so far this year.
Coming from a low bar, and this question of how much further it can go, a lot of people are saying, look, it can't go down much more on a relative basis. And if you do get stimulus, that could be supportive in a new way.
We could have some monetary stimulus later on this week. The Federal Reserve set to ease, cut interest rates by 25 basis points, and maybe, who knows, maybe more. Up next, Russ Koesterich of BlackRock, Henrietta Treyz of Veda Partners, the former New York Fed President Bill Dudley, and Earl Davis of BMO. The second hour of Bloomberg Surveillance just around the corner.
As long as we have a solid enough economy then I think the bull story is very much intact.
You don't want to be overly bearish at this point in the cycle.
There's an opportunity cost to being too defensive in this market.
Equity market, I think, definitely thinks that there'll be this reacceleration in the economy.
The stock market just wants to look past the weakness in the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 bouncing back very close to all-time highs, up by 0.2% so far this morning. That's stocks, sneak peek of bonds, 2-year, 10-year, 30-year bond yields. Yields lower at the front end just by a little bit, 355. At the long end on 10s, just north of 4% on 30s. 468. Going into the big one later this week, it's all about Wednesday. Chairman Powell, decision, news conference, and some very important forecasts.
Because right now, it's not necessarily about whether they cut 25 or 50 basis points. It's about the trajectory of what they signal going forward. Do they ratify the market's expectation for 150 basis points of cuts by the end of next year? Could they even go more, and why? Is it because of weakness or is it because of something else? You were talking about 2 10s, 30s. I'm watching the 10s. President Trump was talking about mortgage rates. Let's see what happens with the mortgage rates if the Fed does signal it's ready to go big.
Bond yields down for 4 consecutive weeks to the long end on 10s. That's something I don't think we've seen since, I believe, February. So it's been quite a while. That's a decent run. Let's talk about why. Is that about the pivot to interest rate cuts from the Federal Reserve, or a bond market that's starting to trade on the weaker economic data that's been building through summer and into September?
I don't know that we know the answer. I'm going to be really honest and say I don't know. It could be a little bit of both, that the weaker data suggests that we aren't going to get this runaway inflation that would make people concerned about buying longer-term bonds. Maybe there's some sense of the income coming from tariffs, but maybe the bond market and the stock market aren't talking to each other. And right now, the bond market is counting on certain aspects that the stock market is just ignoring, because if it really were trading on weakness, why would stocks be rallying to the degree that they are, led by, you got it, the cyclicals and small caps?
Small caps. So the Russell has had a tremendous run through the whole of August and into September. 6 weeks, I believe. Lori Calvasina of RBC on the program a little bit earlier, saying that the Russell and the small caps are trading almost exclusively on rate cut bets. And she finds that problematic because she believes it should be trading on the growth story. And she's not got that much confidence in it.
And she's talking about people who rally around it, then take a look at the fundamentals and say, oh no, and run the other way. Julian Emanuel of Evercore ISI put it really well over the weekend when he said the ultimate difference between whether you get a risk asset rally after Wednesday or not will be whether the Fed is cutting because they have to or because they can. Right now, the market is betting that they will because they can, and because the composition on the Fed will allow them to tweak things on the edges to help the long end as well.
The rally continues, positive by 0.2% on the S&P 500. Coming up this hour, we'll catch up with Russ Koesterich of BlackRock, with stocks rallying ahead of this week's Fed decision. Henrietta Treyz of Veda Partners joins us as the US and China work to hammer out a trade deal, and the former New York Fed President Bill Dudley as President Trump pushes for a big rate cut. We begin this out with stocks reaching record highs as investors bank on the first Fed cut of the year so far. Russ Koesterich of BlackRock looking beyond this week, writing, we expect a resumption of the Fed's easing campaign to begin with the September meeting and continue into 2026. Russ joins us now for more. Russ, welcome to the program, sir. Let's talk about those expectations for 26. Less interested in 25. What's the big view into next year?
Hey, good morning, Jonathan. I think the big view is the Fed is going to begin their cutting cycle. Now, again, we can debate how far it goes, how long it goes, but this is interesting because it's not just this question of do they have to, can they? It's also the context. And the context is that while we have generally some weakening in the labor market, we know there are parts of the consumer space that are feeling some pain. Generally, the economy is doing okay. We printed 3.3% growth in Q2. So we're not getting these cuts in the context of a collapsing economy, in imminent recession. And generally, when you see the Fed cutting and the economy in decent shape, that for the most part has been a good environment for risky assets.
So, Russ, that's a good argument for equities. But you've also got an argument for bonds too. And Lisa and I have been talking about this recent outperformance of the long end, the flattening we've seen over the past 2 weeks, and the pitch from you and the team that maybe now is a good time to start adding some duration back in. What do you think is driving the long end of the curve now?
The long end is a little bit different. To be clear, we've been adding a lot of our duration in the front to the belly of the curve, which is the part we generally like the most. We have added a bit more longer out, and we've gotten our duration closer to benchmark. So what's happening? A couple things. One, obviously, changing reaction function from the Fed. But the also is, the other factor is, we don't believe we're heading into recession. We've had some very clear signs over the last, several months. One, that despite the tariffs, we're not getting that expected significant spike in inflation. And second, and more to the point, the labor market has softened significantly. Now, again, to some extent, it can soften because we're in an environment where the supply of labor is much slower than it was in 23 and 24 when immigration was higher. So a 4.3% unemployment rate, not that scary, but the job creation, that's definitely slowing. I think the bond market is partly reacting to that in particular.
How much, Russ, do you think the bond market's reacting to the expectation that the Fed and the Treasury will work in tandem to issue fewer long bonds and potentially tweak some of the purchases of the Fed's balance sheet to give a supportive oomph to some of these bonds?
That may be part of it. I think the other part of it is that while we definitely have a long-term fiscal problem, one of the things that is occurring is that with this sharp jump in tariffs, you are seeing a rise in government revenue. So that, again, long-term, we can debate whether or not that's going to be offset, the spending, the tax cuts. But the reality is we're not seeing a significant deterioration in real time. And one of the reasons the long end of the curve has come down so sharply is that term premium has come down.
I guess I'm trying to put this all together, Russ, because in the past, when bonds rallied on the prospect of slower growth, that wasn't great for cyclical stocks, and you wouldn't see this rebound, and you wouldn't see this rebound in profits. And at the same time, people are saying, well, there's value there from a returns perspective. Where is the dissonance here in terms of, is this still the soft landing people were looking for? What are people getting wrong when they say either we're going to get some sort of reacceleration in inflation or you're going to get some sort of more significant downturn as signified by some of the employment data of late?
So this, I think, is exactly the right question. I think the disconnect is the junk, small cap, lower quality value rally. Now, we've seen a bunch of these before. There was an anti-momentum trade in July. That it's become a seasonal thing. We've seen probably 4 or 5 small cap rallies the last 18 months. It's been a rent not own trade. But I completely agree with you. If your thesis is, look, the Fed is cutting because the economy is moderating, the labor market is slowing, it's not obvious why you go down in quality, buying small caps, buying some of the value names that have been ripping in a world in which you're going to get less operating leverage because the economy is a bit more moderate. In that environment, I would expect growth in quality to lead. Now, to be clear, a lot of the AI trades have done exceptionally well. We saw Oracle last week. Having said that, I do think that if we are going to have a slower economy and we are going to see the Fed cutting into that, that's not the optimal environment. That's not the optimal regime for some of these more speculative trades that have been working over the past 10 to 12 weeks. I would start to fade those.
Russ, how much are we seeing the return of Buy America in bulk? This idea that any kind of Sell America earlier this year has retraced and then it's continuing to build versus sort of an equilibrium now once that sort of buy, sell, buy really took hold?
I think we're in a little bit of an equilibrium, and it's interesting. If you look at the S&P 500, you look at the SX5E in Europe, you look at the Nikkei, they're all within 1 or 2% of each other. So, that early underperformance by the U.S. has been closed. And we're in a world where the regional differences in returns have been much more a function of the currency effect than it has been in the markets. But I do think the U.S. is still probably the best bet longer term. And the simple reason for that is earnings. Again, look at Q2. We had all the uncertainty about tariffs. You started the season with expectations for 4% growth. You ended with 11 to 12% growth. Where was the strongest growth? Technology, communications, areas where the rest of the world tends to be underweight. So as long as that dynamic's in place, as long as those secular trends are in place, I still think the U.S. can outperform over the longer term.
Russ, you just mentioned the currency factor. Let's lean into that just a little bit. What are the benefits from here looking out of continuing to maintain that allocation to gold?
The gold is, I think, it's a smaller allocation, but it is critical because of what it does in the portfolio. And it's a bit tricky. Jonathan, as you know, a lot of people think about it as an inflation hedge. Well, that didn't work so well in 2022 when rates were skyrocketing. Gold in our mind, is a store of value. And in particular, it's a store of value given, concerns about the dollar long term, given concerns about deficits long term. And let's be clear, it's not just the U.S. We've had fiscal concerns that have affected the market in Japan, or recently in France. In a world where you have these structural deficits, I think one of the things investors are looking for is what asset can I own governments can't print more of. That's why gold has been working, in my opinion. And given the dynamics, I think it continues to work over the coming years.
It's had another massive year so far, at least. Russ, appreciate your insight and your input. Russ Koesterich there of BlackRock, the latest on financial markets. Speaking of deficits, let's make it super local, hyper local. Let's bring it all the way here to New York City. Governor Kathy Hochul of New York, endorsing the mayoral candidate for New York City, Zohran Mamdani. The president saying this on social media: this is a rather shocking development and a very bad one for New York City. How can such a thing happen? Washington will be watching this situation very closely. And then the important line here, Lisa: no reason to be sending good money after bad.
In some ways, his interference or his involvement in this election is going to expedite a number of Democrats coalescing around Zohran Mamdani. And you've already seen that with Democrats saying we can't let him win, right? This is turning it into which side are you on? And this is the big fear, actually, for Democrats, is that Zohran Mamdani will end up representing the Democratic Party in the midterm elections. It just highlights, and I really am going to take a little bit of a liberty, but it highlights how polarized in us versus them it has become, rather than looking at an issue-based type of doctrine and figuring out what could be best for each region and for each individual.
I'm still trying to figure out who us versus them actually is, because the president won't even endorse the Republican candidate for this race.
Well, look, this is a really key question. How do you get a sort of coalescing around an ideology when there are parties that are so deeply fractured? With Zohran Mamdani, Kathy Hochul said, as a consummate capitalist, she endorses him. At the same time, it's clear that she's trying to put some ring fencing around some of his proposals, like raising taxes on wealthier individuals. All of this coming under a lot of threats of President Trump potentially taking money away from New York City.
The drumbeat continues running up to November and that important election here in New York City. With the latest news elsewhere, with our top stories worldwide, with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. U.S. and Chinese officials are on their second day of trade and economic talks in Madrid. Treasury Secretary Scott Bessent said the U.S. made good progress on technical details with China, but added that when it comes to TikTok, the Chinese side had made aggressive asks. He did not elaborate further. Officials are expected to lay the groundwork for a meeting between Presidents Trump and Xi Jinping as soon as next month. Meanwhile, U.S. Secretary of State Marco Rubio made comments after meeting with Israel Prime Minister Benjamin Netanyahu in Israel. Rubio saying the U.S. stands with Israel and that Hamas needs to be eliminated and all hostages must be returned immediately. Rubio also said the U.S. will maintain maximum pressure on Iran, which has been backing Hamas. And the Trump administration held a vigil for Charlie Kirk at the Kennedy Center last night. While President Trump was not at the vigil, he says he will attend Kirk's funeral this coming weekend. Kirk, of course, was shot and killed last week at Utah Valley University while hosting an event. Charges are expected to be filed against the 22-year-old suspect, Tyler Robinson, tomorrow. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, tough talks with China.
We had talks going on. Scott Bessent is there and some others. Jameson is here. And I think they're going fine. You know what China is paying right now in tariffs? Huh? A lot.
Up next, Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Stocks are positive this morning. Good morning to you all. Higher by 0.2% on the S&P 500. On the Nasdaq, what a run. On the Nasdaq 100, 8 consecutive days of gains and looking for day 9. Up 0.1% so far this morning. Under surveillance this morning, tough talks with China.
We had talks going on. Scott Bessent is there and some others. Jameson is here. And I think they're going fine. We've hit them very hard in so many other ways. I don't know if you know. Do you know what they're paying right now? What are they paying right now? You know what China's paying right now in tariffs? Huh? A lot.
So here's the latest this morning. China ruling NVIDIA violated anti-monopoly laws with a 2020 acquisition, just as the US and China get together in Madrid for a second day of trade talks. Bloomberg's Tyler Kendall joins us now for the latest. Tyler, so let's put it all together. We've got the talks in Madrid and then the pressure building elsewhere.
Right, exactly, John. And as you pointed out, this acquisition in question here when it comes to NVIDIA was approved 4 years ago in 2020 on the condition that NVIDIA wasn't going to discriminate against Chinese companies. So that timing really was a surprise, but it also did continue this trend of mounting pressure really from both sides here ahead of the talks in Madrid, right? You had China announcing over the weekend an anti-dumping investigation into certain chips, including those made by Texas Instruments. But then you had the U.S. adding some 23 Chinese companies to its entity list for further restrictions. But NVIDIA itself is, of course, this really interesting case because it has repeatedly found itself in the center of these sensitive negotiations. Just weeks ago, you had the administration greenlighting the sale of certain NVIDIA chips into China, including those H20s, only for Beijing to actually urge local companies against using them. But it goes to show how there have repeatedly been these sort of moves, these sort of concessions just to keep the de-escalation in place, which actually up to this point has seemed to be really the main objective as both sides continue to negotiate on the levies, market access, we know in particular for U.S. agricultural products, but then also making sure that those export licenses continue to flow when it comes to critical minerals. So pressure from a lot of different places, and now we've gotten this wrinkle that TikTok appears to be at the forefront of the conversation, as the Treasury Secretary Scott Bessent says that progress has been made, but that China made some pretty steep demands when it comes to the potential for a deal. John, really pressure from all over. Just to go back to the original question, as we know that the U.S. is now also urging allies to include those secondary tariffs on China when it comes to its imports of Russian energy supplies. It really completes the picture that we've seen in the last few weeks as China invited Russia and India to the country for its own security summit.
Tyler Kendall with the latest. Looking at NVIDIA and other issues as well. NVIDIA down in the pre-market by close to 2%. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, welcome back to the programme. Are we doing a lot of work here just to stand still?
Yeah, absolutely. I think that both sides are just trying to get away with the bare minimum of poking one another without getting into any real trouble. So I'm not expecting tariffs to escalate back to 145%, which the president had on earlier this year. But I'm also not expecting China to purchase any U.S. soy, which is a massive problem and a mounting one for the Trump administration. There are 0 orders placed with the farming community for soy from the world's largest purchaser of soybeans. So it's a big problem domestically that I think is getting a lot more outspoken than the Trump administration would have anticipated.
It seems like we're talking about security issues on both sides. It seems like there's anti-dumping concerns on both sides. Are we getting a clear contour of what the ultimate goal on both sides looks like for this trading relationship?
I don't think so, because I think ag is the easiest off-ramp here. And now we're inserting TikTok into the conversation again. And even when we're giving on NVIDIA, China turns around and says, no, that's cool. We don't want those chips anyway. I don't see this coalescing around a clear objective that can get us to another repeat of sort of the phase 1 agreement that was reached in 2020. That's not the direction that I'm seeing right now. And the expansion into TikTok is really the key signal for me.
How much is this a story about China? How much is this a story about Russia? How intertwined are these two stories as the Chinese and U.S. delegations meet in Madrid?
You know, I'd really put the Senate Republican Conference right in the middle of that conversation. There are 85 senators who want the president to acquiesce to their sanctions package and put on real sanctions against Vladimir Putin. And President Trump continues to resist that effort, and he has given them the Heisman for months now. And I think that's really what's going on with China. And when the president comes out with these massive contingencies, like every single NATO nation has to sanction Russia, by tariffing China and India, you get a clear instance of an off-ramp where the president is once again declaring that he will not pass that sanctions bill, not let Senator Thune bring that to the floor. So I think it's actually a 3-way situation here that really centers around the United States Senate and the power that they have, that they are not exercising so long as Trump gives them an off-ramp.
Henrietta, doesn't the president have a point to put the pressure on their European partners to say that if you really want to go hard on Russia, this is what you need to do?
I think so, absolutely. But the United States has a very bifurcated approach to the Russia sanctions as well. We'll put tariffs of 50% on India, but not on China. It's obviously a conflict of interest in terms of going to the EU and then saying, hey, y'all, you do this, even though you're going to have to deal with the economic ramifications much more than we will. I also think it's a little duplicitous to say energy prices are low, gas prices are low. Oh, but by the way, I want you to put massive sanctions on anybody buying Russian oil, which will, of course, spur price increases on oil and gas, especially domestically, when we have already high electricity prices. So I think there's a lot of talking out of both sides of your mouth here.
But the messaging is so effective because it exposes the core contradiction of the Europeans, Henrietta, as you know, that they would like the US to join them to go hard on sanctions at the same time they continue to consume Russian energy. Henrietta, what can we do about that? Because that, for me, is the heart of the biggest contradiction in all of this.
Yeah, I think you've got to be able to have a little bit of leeway where you don't make demands like every single NATO nation has to do X, Y, and Z before we will do, F. So that's sort of the direction that I think the administration has gone, which is we will make such high contingencies that we can't find a middle ground. I'd be really surprised if there was anything that came out of the UK, for example, later on this week that suggested that they were going to work in tandem on this. You can jawbone about it, but we obviously need more from the administration in order to actually get Putin to stop invading Ukraine and then branching out into Poland and elsewhere, which is what's occurring.
This was one of the strategies on the part of Russia to split the West, to get the sense that NATO wasn't going to necessarily work together to rein any kind of the fighting in. I wonder if you could just take a step back, given what's happened over the past couple of weeks and given what we're looking at in terms of a likely government shutdown in about 2 weeks' time, and say, have you ever seen, just in terms of both the United States and Europe, a more fractured political backdrop for some of these types of discussions in recent history?
That's an excellent point. And let's layer on that you also have a lot of staunch NATO allies who've taken a back seat in the last year of domestic politics. I'm thinking specifically of Mitch McConnell, for example, who's no longer the majority leader. And he was the main advocate for increased aid to Ukraine, which is another way to, avoid sanctions if you want to, provide aid to Ukraine, provide more funding to get out there. And that's not occurring now. But while we go into this discussion about a government shutdown, you can link all these issues together, which is the best part of this job, is you can tie in a potential farmers bailout. You can tie in more aid to Ukraine, stronger signaling towards NATO, and the administration's willingness to negotiate on a funding deal that will keep $2 trillion in funding going, including $914 billion just to defense. So there's a way to link all of those issues together. And we have a deadline coming up of September 30th. And that's where you can really extract some concessions. And I think that's what we'll get, not in the week that we're in right now, not this week, but over the 10-day recess they're about to get into, and then definitely over the last 48 hours before a shutdown.
There's nothing easy about this. Joining the dots there, Henrietta Treyz there of Veda Partners. Henrietta, thank you. When this war first started, I remember sitting around the table with you and TK talking about this going on for weeks, potentially months. It stretched for years. The president wanted to end it quickly. It is very difficult to end this quickly.
You have Ukraine, which faces an existential threat of its land, and you've got Russia, which believes that Ukraine should be part of Russia and seems pretty set on continuing with the incursion. The question is, are we reaching a tipping point where the escalation has gotten a little bit more extreme, at least from Russia's side, and then also from Ukraine's side? And how does this sort of come to some sort of denouement given the disagreement of how to deal with it?
And that's the latest on geopolitics. Up next on the programme, we bring it back here to the United States and a big decision taking place for financial markets worldwide. Coming up, we'll catch up with the former New York Fed President Bill Dudley as President Trump pushes for the Fed to go big. Plus, Danny Berger has your morning movers. Danny, looking at Tesla as Elon Musk doubles down on the company. That stock is up at a pre-market by more than 7%. From New York City, you're watching Bloomberg TV. Two-week winner streak on the S&P 500, likewise on the Nasdaq, up again to kick off the trading week, higher by 0.2% on the S&P, up by about a tenth on the Nasdaq. With 2 hours until the opening bell, let's get you some morning movers. Here's Danny with more. Hey, Danny.
Hey, John. One of the big decliners this morning, at least in terms of market cap weight, is Nvidia, down 1.6%, following China finding that the company violated their anti-monopoly rules over a purchase of a company called Mellanox. It's a networking gear maker. But all of this, the backdrop, are the high-profile meetings between China and the U.S. in Madrid. So that may be casting a cloud over those discussions. Again, those shares just down under 2%. Meanwhile, Tesla to the upside, which is maybe why the Nasdaq is performing, even with a weak share action in Nvidia. Shares are up 7.7%. Elon Musk, according to a filing on Friday, bought $1 billion worth of shares of Tesla. That translates to about 1.5 million shares. It comes after that $1 trillion pay package over the next 10 years if Elon Musk can meet those punchy projections and targets. So maybe a doubling down for Musk and a show of confidence after that. Finally, a story from the Wall Street Journal flagging that United Health has hired advisors from specifically Trump allies in order to try to ingratiate themselves with this administration. They've, according to the Wall Street Journal, met with Susie Wiles, met with Justice Department officials. Shares were up higher, starting to weaken a little bit, but again, they face a lot of pressure, be it government probes or less payments when it comes to things like their Medicare Advantage program. So those shares just notching into the green, John.
Danny, thank you. More from Danny in the next hour. Given what industry they're in, I'm surprised it's taken this long, aren't you?
I think pretty much any industry that touches regulation in Washington, D.C. and has a popular type of interface would have to be on this kind of level where you want to get some people around you who have some voice into Washington, D.C.
The latest from United Healthcare, from Danny Berger. More from Danny in the following hour. On a radar this morning, President Trump pushing the Federal Reserve to go big as they meet this week. The president calling Fed Chair Jay Powell incompetent and blaming him for the slumping housing market. Elsewhere, the Treasury Secretary Scott Bessent meeting with Chinese officials again today in Madrid to discuss trade and TikTok. The talks setting up a potential summit between President Trump and Xi as soon as October.
TikTok. I love this. I mean, the story that won't go away, the deadline that just keeps on getting pushed back. Still, sort of a random wheel of what exactly they'd be talking about. We could imagine it would be rare earth metals. We could imagine it would be chips. But the fact that it's like boop, 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 TikTok, it sort of highlights how much is at play and how this is sort of a template for whether this is a national security concern or whether this is an effort to try to deepen international ties.
I think it's always been a national security concern. They just don't want to do anything about it because of a issue of popularity with the electorate, particularly the younger cohort. And we've seen that play out repeatedly, not just in this administration, but the previous one as well.
It highlights a real tension of how to reach out to younger voters at a time where there has been a huge transformation in the way they get their news. And it highlights a real discomfort with getting rid of a platform, even if it's for national security, that has proven instrumental in a lot of election campaigns. And you see this time and time again. We have seen members of Congress try to coalesce around it. But at risk of losing their seats, they're not willing to go that far.
What's curious about what's happening in Madrid on this front is that, according to a senior official on the US side, the Chinese delegation thought these discussions, both TikTok and trade, would be dealt with together, and the US administration wants to deal with them separately. Are they going to agree on that? Is that the big agreement we can expect, that they're actually just going to put this off to one side?
Talk about lowering the bar. I mean, really.
I'm serious, though.
I know.
What kind of breakthrough are we looking for here?
I think that the expectations are pretty low. It's sort of when you keep talking with your adversary, you avoid some of the blows that come with some pent-up anger. And so the goal is just to keep talking through their emotions on the U.S. side, on the Chinese side. Tell us how you feel, and then we can go back and just kind of keep the peace.
And financial markets kind of like that, so long as there's no escalation. And they just keep talking. They will keep talking. That's the latest from Madrid. Not much so far to report. Elsewhere, New York Governor Kathy Hochul endorsing Democratic Socialist Zohran Mamdani in his bid to be the mayor of New York City. Trump responding on Truth Social, saying the following: no reason to be spending good money after bad.
Yeah, and a real question of how his involvement in this mayoral race really coalesces support around Zohran Mamdani. And the reason why I'm saying this, I'm just going to quote the governor, Kathy Hochul, herself in this Times opinion piece. She said, Zohran Mamdani and I both will be fearless in confronting the president's extreme agenda with urgency, conviction, and the defiance that defines New York. She made sure to distinguish herself from him when it came to capitalism versus socialism, when it came to raising taxes on wealthy individuals, saying that she's had some robust disagreements with him. But there still is this feeling that as long as the president tightens the screws, there needs to be some sort of linking of arms and fighting back. And it raises a question of how this will escalate with other Democratic leaders, not only for this election, but heading into the midterms.
I would just say this. It would be unfortunate if this election comes down to New York City versus the president. I think for a lot of people living in New York City, it's not about New York City versus the president. It's about issues right here in New York City that New Yorkers can address, regardless of what's happening and who's in the White House down in Washington, D.C.
Here in New York City, when you go to different circles, that normally is the conversation. But the politics of the moment changes that in terms of how it's being discussed. And I agree with you. I hope that people really debate the merits of different methods to try to achieve things like more affordable housing and a better opportunity for families. It really is about the method as much as it is about the goals.
The election a few months away. Let's turn back to the Federal Reserve. The president pushing for Fed Chair Jay Powell to go big.
The Fed chairman's incompetent. I think you have a big cut because I don't think he can help with cutting. It's perfect for cutting.
Traders betting with near certainty the Federal Reserve will cut interest rates by 25 basis points this week. Joining us to discuss, the former New York Fed President, Bill Dudley. Bill, welcome back, sir. Let's get straight to it. What are you expecting to see this coming Wednesday?
Right along with everybody else, I expect a quarter-point cut. It's baked in the cake. I'd be surprised if they do anything else.
Do you think they'll guide much beyond that?
Well, there'll be guidance because they're going to publish the summary of economic projections, which shows their interest rate outlook for the rest of the year and into 2026 and 2027. And I think the big debate there is, do they show one more cut after September or do they show two more cuts? And I think it's going to be a very close call between those two outcomes.
Yeah, Bill, I think we should build on that. That's the interesting piece of information for me. That at the last meeting, the last round of forecasts, if you will, they were forecasting two cuts. And they had unemployment year-end at about 4.5%. And, Bill, we could have this really strange situation where people are basically looking for the unemployment rate to stay steady in the forecast, but all the dots to come down. Bill, just what's happening there? What is actually driving the outlook for rate cuts? If it's not unemployment, what is it?
Well, I think you're right that the forecast is evolving pretty close to what they had the last summary of economic projections in June. So if they're on the same forecast track, why would they pencil in more rate cuts? I think the thing that's changed is just this weakness of the labor market in the sense of payroll employment growth. It's only been 30,000 a month over the last 3 months. And you see a lot of indicators that the labor market is continuing to soften. So I think it's more the softness of a lot of the labor market indicators that are getting them concerned that the labor market could continue to deteriorate. So I think that's the biggest risk right now. And so that's what's causing them to have a little bit greater urgency.
Bill, doesn't the market agree with them? Isn't that the takeaway from the rally that we've seen in the long end of the yield curve?
Yeah, absolutely. I mean, market is in agreement that rates are coming down, not just this year, but in 2026 and 2027. In fact, the market, if you look at the federal funds futures market, it has rates coming all the way down to about 3% on the federal funds rate by the end of next year. So there's a lot of rate cuts priced in. I think, personally, I think it's not quite so clear that they're going to go that far over the medium to longer term because the financial conditions are already very, very accommodative. And the economy is not falling out of bed. I also think we haven't seen the full effects of the tariffs in terms of prices yet. So I think inflation is going to stay sticky over the next 6 to 12 months.
So I want to dig a little bit deeper into what you just said, the idea that the long end of the yield curve is pricing in steeper cuts. You could make the argument that if the economy isn't falling out of bed, that any steeper cuts would cause a reacceleration in inflation and potentially some deterioration in the dollar that could cause kind of the opposite in the long end in terms of a sell-off and a yield curve steepening. What's your understanding of why the market doesn't seem concerned about that?
Well, I think they think that the reasons for cutting now are actually quite compelling, given that the inflation pass-through from tariffs has been smaller than expected, and the weakness in the labor market has been at least as large as expected. So I think the market is, shares the view of Jay Powell that the downside risk to the labor market outweigh the upside risk to the inflation. So therefore, rate cuts are warranted. But I think the question is, how far are they going to go over the medium to longer term? That's where the markets, I think, may be a little bit ahead of themselves. Now, some of this is hard to factor in how much is the pressure of the Trump administration on the Fed, and some risk that the Trump administration could compromise the independence of the Fed. Now, obviously, if the Trump administration is successful in doing that, that's going to be lower rates, but it's also going to be higher inflation.
Bill, just to talk about what we might get from the news conference as well with Chairman Powell, how difficult is it going to be for him to establish a consensus at this meeting? If you go back to the last dot plot, and things may have changed, but in the last dot plot, there were a big group of individuals that saw no cuts in 2025. And I'm just wondering how much has changed, not just for Chairman Powell. He's indicated a lot has changed based on the last few times we've heard from him, but for other members of the committee.
I think most people are going to go along with what Chair Powell wants because they're not in disagreement about the direction of rates. They're just maybe have a small disagreement about timing. Should we start in September or should we wait a little bit longer? So the fact that they're all in agreement that rates are going to be coming down, I think they're going to give the chairman what he wants at this meeting. So I'm actually expecting very few dissents on the side of no rate cuts, maybe 0 or 1. The other side of the equation is, are we going to get 50 people supporting a 50 basis point rate cut? And I think the only person I'm expecting there perhaps is Steve Moran if he gets confirmed and is sitting on the FOMC on Wednesday afternoon.
Bill, do you think that it's healthy to have a character like Stephen Miron on the Federal Reserve, on the Board of Governors, to really foster a robust debate about not just whether to cut 25 or 50 basis points, but the overarching framework that the Fed is operating in?
I think it's good to have a diversity of views on the Federal Reserve to debate a lot of, the framework. I think the Fed could do quite a bit more in terms of developing a framework for quantitative easing and quantitative tightening. And I've written about that over the last few months. So I think there are things for the Fed to do. I think it's a little odd to have someone that's essentially on loan from the administration for 4 months to vote at 2 or 3 meetings. So I don't think that, Steve Moran's going to get a lot of deference at the meeting this coming week.
Bill, for people who aren't familiar with the meeting, a meeting that you've been a part of many, many times, can you describe to them what that kind of room will look like, that situation, how the meeting actually progresses, who runs things, and what kind of opportunity Stephen Miron would have as he sits around that table to make his points?
So the meetings typically are obviously chaired by the chairman, and there's typically a discussion about the economy. Everybody goes around and gives their views on the economy, and then there's a discussion about monetary policy. Everybody goes around the room and talks about their views on monetary policy. So Steve Moran will have a chance to speak on both of those, but he's going to be only one of 19 people speaking. So the idea that he would go there and dominate the meeting, I think his influence is going to be quite small.
Bill, do you take it in turns? Are there any kind of debates at all, or do you just go around one by one around 19 individuals?
No, there can be some back and forth. People do respond to what other people say. But I mean, remember, everybody's looking at the same set of information. So the disagreements tend to be small, more at the margin rather than large, because everybody's looking at the same set of information, hearing the same staff forecast, evaluating the same economic information.
Bill, appreciate your insight, your experience too. Bill Dudley, the former New York Fed president. It's not quite the fight that people might be imagining that takes place at the Federal Reserve.
I love this. You're trying to sort of goad him into this idea of, how dare you say that things are weakening in my district, or this feeling that there's sort of this robust kind of UK-style parliament kind of disagreement. Anything, it sounds like not so much.
Attempting to get Bill to draw on his experience to articulate how boring these meetings actually are.
Well, that was successful, to go around the room and say one by one. Look, he's correct in the idea that there are 19 different people giving their points of view. However, how many people send notes or send little emails messages, or little scathing texts to one another?
I'm sure that bitchy now and again on the FOMC. Right?
I have no doubt. I mean, honestly, humans are humans.
You break for lunch, like Mean Girls, different directions.
Totally. Who gets to sit with who?
Yeah,
Some
something
people
like
sit
that.
alone.
Yeah,
Stephen Miron
that's
would not have a lunch
pretty
buddy.
sad, isn't it? OK, Stephen Miron might be there. Based on the vote we get a little bit later, we're expecting him to be there as that 2-day meeting begins tomorrow morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump is again threatening to federalize Washington, D.C. after his recent deployment of the National Guard. In a Truth Social post overnight, the president said D.C. Mayor Muriel Bowser told the federal government that local police will no longer cooperate with ICE. The president says crime would come roaring back if that were to happen, and if necessary, he'll call a a national emergency. Meanwhile, in a potential settlement with the Trump administration, Harvard University could be required to invest $500 million to build trade schools. This comes as part of President Trump's attempt to squeeze billions of dollars out of the Ivy League university. Brown University has already agreed to spend $50 million over 10 years on a workforce training for vocational programs. And Scottie Scheffler getting warmed up for the Ryder Cup with a win at the Pro Core Championship in Napa. The world #1 golfer started the tournament a bit sluggish, but came back from 2 strokes down to secure a 1-stroke victory at 19 under. This was Scheffler's 6th win of the year and his 19th career PGA Tour win. His season earnings are over $27.6 million. That's your Bloomberg Brief. John?
It's not bad, is it? 30 mil for season's earnings.
Yeah, but just think we could get if you were some kind of AI genius over at OpenAI.
True.
No, but
30 mil every single week.
Exactly. You just get that per hour. But honestly, well done to him. He just doesn't seem to do anything but win.
Amazing. Ryder Cup about a week away. Very cool. Up next on the program, the risk of reacceleration.
I don't think if they cut, that would be the cause of reacceleration. If it reaccelerates, it will be because the economy was not that soft to begin with.
Earl Davis of BMO Global Asset Management joins us in a few minutes' time. Live from New York, you're watching Bloomberg TV. Stocks are doing just fine, up by 0.2% on the S&P 500, up by 0.14 on the Nasdaq, and the rally continues on small caps. The Russell up by 0.3. Under surveillance this morning, the risk of reacceleration.
I don't think if they cut, that would be the cause of reacceleration. If it reaccelerates, it will be because the economy was not that soft to begin with, and they cut because of all sorts of reasons. The likelihood that they will move the economy in a meaningful way, I think, is up in the air.
So here's the latest this morning. Diverging views on Wall Street ahead of the Fed's interest rate decision on Wednesday. Some traders expecting rate cuts could add to inflation concerns. Earl Davis of BMO writing, we remain constructive on U.S. economic growth heading into 26 based upon the big, beautiful bill and deregulation. Earl joins us now for more. Earl, welcome. Let's address that quote. Not about interest rate cuts. It's about the one big, beautiful bill and deregulation. What do you think is still underappreciated that's coming from Washington?
Well, what's interesting about that question, what I feel is underappreciating, is the global fiscal impulse. Because you're seeing fiscal easing not just in the U.S., but you're seeing it in China. You're seeing it in Japan, and that's going to probably accelerate with the new election. And you're seeing it in Europe. So we do feel the fiscal impulse will lead to higher than expected growth globally, and especially in the U.S. in 2026.
Why does that lead to lower long-term rates?
Yeah, well, there's 2 paths actually that lower long-term rates could go. So lower long-term rates, we do feel there'll be risk premium that goes into it, and it leads to lower long-term rates. When you're talking about corporate rates, actually, there may be corporate spreads may be further compressed because as equities do well, as risk assets do well, pensions become fully funded. Insurance companies with increased annuities, they have to buy long-dated corporate bonds. So there could actually be, perversely, a very strong bid for long-dated corporate bonds, which will compress it against treasuries.
It sounds clean, and I can understand it. At the same time, when I take a look at the economic data, I'm struggling. I'm trying to understand, is this economy weakening? Is this an economy where people cannot get jobs and don't have confidence that inflation is going to come down? Or is this an economy that just hasn't seen the best yet, that just hasn't seen some sort of stimulus that can both boost growth without really influencing inflation? Which is it?
Yeah, well, what's interesting, on the short term, it's definitely weakening. But we always ask ourselves, when we see what the market is doing, is it persistent or is it sustainable? We see it being persistent and sustainable for 2025. And the reason why is we do see unemployment bending. Having said that, the uncertainty that's been taken out of the market, that is significant. And what I mean is that tariff uncertainty. Now businesses know the economics of investing. I think we have to wait for the ruling in October. After we get over the ruling in October on tariffs, that is specifically, that takes out the final leg of uncertainty. And then that we think is the catalyst for the big boost.
So, Earl, as you know, stocks are an anticipatory asset class. They're anticipating a lot of this. Stocks are close to all-time highs. In addition to that, credit spreads are very, very tight. Earl, can you just walk me through the way you're thinking about interest rate reductions and the cash on the sidelines, so to speak, a phrase that I know a lot of people don't like, but how much of that money is actually going to come into risk as this Fed is cutting rates?
Yeah, so just to walk through that, so the cash overnight rates are, let's call it 4.25, 450. That in itself is the highest level on the whole yield curve. So, money market has in and of itself become an asset class, someplace where you could park money and earn a very good return. The dynamic of that starts changes with central bank eases. What's discounted in the market this year is 75 basis points almost this year and 75 next year. Any changes to those expectations? So if people are expecting 100 basis points this year, you will see another bid to corporate credit because more money is going to come out of money market accounts into risk assets to ensure that they're still earning 4% or higher return. And the more discounts that come in, the more discounting of easing that comes into the market, that accelerates that. So we think we're in a new structural paradigm with lower credit spreads, tighter credit spreads. Having said that, it becomes very important to watch the defensive side of things, which active managers do, because if a company or something goes boo in the night, you want to ensure that you're in the right credit. So I think it's very important to look at that. We think structurally lower credits, tight credit spreads, but it increases the importance of what you're invested in.
Well, typically, where does that cash migrate to? Fixed income's a huge asset class. Does it go everywhere? Equally, where would you expect it to be concentrated?
Yeah, I do expect it to go everywhere equally because the redistribution of one asset class to others. Well, sorry, let me rephrase that. I do expect it to go everywhere. Not necessarily equally, I think along the same proportion of what we're seeing now. You'll see a very good amount go to equities. You'll see a very good amount go to corporate bonds. And you'll see a modest to decent amount go to the alternatives. Gold is another asset class that you have to be aware of. I think that will take a lot of the money that comes out of money market accounts as well from the safety aspect.
Just 30 seconds, Earl. Do you think fewer dollars are going to end up going to developed market bonds and instead go to investment grade corporate bonds?
Yeah, it's different investors. Money market investors won't go into treasuries because they're going to earn less than they earn in money markets. So different investor class. I do think, we're seeing the sovereign buying of bonds. We're seeing, like I said, the pension de-risking buying a bond. So it's a different asset class. So I don't think that will impact bonds per se.
Earl Davis, appreciate it, sir. Thank you. Of BMO Global Asset Management. Gold creeping its way back into the conversation again. Heard the same thing from Russ Koesterich of BlackRock earlier.
Yeah, if you're going to protest the dollar, where are you going to go? Are you really going to go to the euro? It has been gold time and time again. And the rally on some measures has been the most fierce going back to 1979 in terms of the trajectory upward. And a lot of people say it has room to continue just based on the fact that where else are you going to go?
No income streams there, just mass appreciation over the last year.
Wasn't it Jamie Dimon who said that it was a pet rock? And I think that a lot of people are saying it's a pet rock I could use. It comforts me at night, and I might go to Petco and buy some gold food.
It's doing the right thing. It's a well-behaved pet rock. Let's put it that way.
It
Explosive.
It's very, very nice. Sit there.
Just about positive so far this morning. Coming up, Seema Shah of Principal Asset Management, Tom Narayan of RBC, Abigail Watt of UBS, Greg Peters of PGIM. The third hour of Bloomberg Surveillance is just around the corner.
Federal Reserve has done its job, we think, remarkably well.
There's no question that you want to be moving rates at least back towards a more neutral setting.
The Fed will still probably be looking for 2 cuts this year.
You have the Fed rate cuts helping those sectors of the economy that are very rate sensitive.
The economy is not going to slide into recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, Bloomberg Surveillance and the third hour starts right now. Your scores look like this. Equity futures on the S&P 500 just about positive across the board, up by 0.2%. 2 weeks of gains on the S&P and on the Nasdaq. For the bond market, 4 weeks of lower yields at the long end of the curve. The 10-year yield this morning, just a little bit, north of 4% at 4.07%, and the week ahead dominated by one thing. The Federal Reserve and the meeting taking place on Wednesday. To borrow a phrase from Governor Waller, let's get on with it.
A lot of people just hoping for the meeting to be over. Let's figure out who's going to be at said meeting. And then what are the projections as they look forward? Before we get there, there's retail sales. And this is really a key question that I have, which is how well is the economy actually holding up? We seem to have moved past that into how much will the Federal Reserve stimulate said U.S. economy. But there still is a huge question about whether the weakness in the labor market is something more persistent and whether we're going to see that expressed in terms of lower consumer spending. Haven't seen it in bulk yet, but there are signs around the edges.
That phrase, the weakness in the labour market, the weakness in payrolls, unemployment has been really quite stable over the last few months. And as for spending, Bank of America, Aditya Bharve came on the programme a few times and he talked about card spending. And he said there was a pickup as we got to the back end of the summer. Are we actually seeing the consumer start to re-engage as well?
Yeah, at a time when some people were saying that those jobless claims were skewed by some interesting different reports over in Texas, and yet people didn't take back the idea that this was going to be something of a weaker read on the U.S. labor market, even though some people were discounting this as a blip, an aberration that also was affected by seasonality. So you put this together and you wonder whether people are awaiting near-term weakness and saying, well, it could spur the Fed to cut rates, but just because they've got an opening to do so, not because there actually is weakness in the underlying economy.
So that's the economy and the Federal Reserve. Now, allow me to confront this in real time because this news is just coming in from the President of the United States, rather active on social media this morning, writing this one. Subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis, but rather to report on a 6-month basis. That will save money and allow managers to focus on properly running their companies. Did you ever hear the statement that China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis? Not good. Now, this is just a social media post in the last few moments. How seriously should we take this recommendation from the president?
You know, I can't answer that, so I'm going to punt, and I'm going to say that ultimately this might give a lens into some of the issues that are on the table as the U.S. heads into this meeting with China and this question of competition and how the U.S. remains competitive, given that some of these companies are going to have to take some difficult steps in the short term to rearrange their supply chains, et cetera, in order to divest a little bit from China. So there's a lot behind this in terms of the context of when he is writing this that I think might be more important than the feasibility of changing the disclosure rules around the SEC.
So let's just take a step back and just say, I think for a lot of people this morning, there will be a supportive view and there will be a critical view. The supportive view would be that we need to take a much longer term vision, have longer term goals. That's what the president's alluding to. This makes sense. What can we do to help achieve that? The supportive view. The more critical view would be this is an effort to reduce transparency at a time when the economy is not doing so well and these companies aren't going to have a good story to tell. That would be the pushback this morning.
And it's going to be directly tied to some of the initiatives that he's been talking about. We've already seen a number of companies raise concerns about hiring plans as a result of some of the trade uncertainty, talk about potential charges that they're going to have to pay. So yes, that is the skeptical view. At the same time, I think that he is correct if it is a longer term sort of focus that he wishes to direct. I just think it's an interesting timing. He's very active on social media this morning.
Incredibly
He's got some time. I wonder what's going on there.
Tyler Kendall's down in Washington, D.C. We're going to go grab her to get her thoughts on the latest in the nation's capital in just a moment. Coming up this hour, over the next 60 minutes, we'll catch up with Seema Shah of Principal Asset Management as stocks trade near all-time highs, Tom Narayan of RBC as tariff headwinds hit the auto sector, and Abigail Watt of UBS with a key Fed meeting just around the corner. We begin this hour with stocks edging higher ahead of Wednesday's Fed rate decision. Seema Shah of Principal Asset Management writing, we anticipate 3 25 basis point cuts this year, followed by a pause as the Fed reassesses the economic landscape. Seema joins us now for more. Seema, good morning.
Great to be here, thanks.
It's not just the Federal Reserve we need to talk about disclosures as well, and we'll get to that in just a moment. Let's start with the Fed. What are you expecting, and do you think there's a bit of tension in this market at the moment, which seems to be overweighting the rate cuts and underweighting some of the reasons for them?
Yeah, that's a good way of putting it. So we are expecting 3 cuts starting, of course, on Wednesday. I don't think there's any questions around that. But we do think they're going to go into a sequence of cuts, try to quickly take the economy to neutral, and then be able to just reassess where things are moving. And I think to your point, the economic data is really confusing right now because you have the labour market, which is slowing, according to some parts of the numbers. But the broader economic picture is fine, it's slowing, but it doesn't seem like it's heading towards recession. You've got credit spreads incredibly tight, earnings looking pretty strong. So I think this is a murky picture, but it's one where the Fed ideally gets in front of this story, ensures that this slowdown doesn't become something which spirals out of control. And then, taking it to neutral at least gives them a moment where they can reflect.
Many investors have sat in your seat and talked about positioning for a re-acceleration in this economy. Would you fade that view?
So I guess I have a slight issue with the word re-acceleration. I think there's going to be a recovery in 2026. I think there's a number of factors which are going to come together. You're going to have, of course, the rate cuts. You've got the fiscal stimulus, ideally some more certainty around where tariffs are heading. And all of that helps the economy move to a slightly stronger path. But we don't see the economy going to above trend growth, even by the end of 2026. So this is a kind of a muddling through scenario. But remember, for equities, you don't need to have really strong growth. Muddling through is okay, just you don't get very strong returns.
Okay, so I guess putting this together, and I'm still distracted trying to understand exactly what it would do to this economy if companies reported less frequently, given the fact that the president is talking about that. Do you expect more clarity from companies to show that they're actually managing well through the uncertainty with tariffs? Are tariffs still a good thing for companies, which has sort of been the takeaway of a lot of the sort of analysis after we've gotten earnings saying, look, they've managed to innovate their way through this. They've actually increased their profit margins much more than we expected, and we expect that to continue. Do you believe that?
I think the challenge is going to get bigger. We do a survey of small businesses, the Wellbeing Index going back many, many years. And the thing that we're seeing from that small business index is that these companies are almost standing still. They don't really know how to navigate this, so they're not raising prices, but their margins are being eaten away. And that can only go on for so long. At some point within the next couple of quarters, they would have to start raising prices, and then you do see some kind of feed through. So I think that it's okay for now. We do need to get further clarity, and I think a lot of businesses themselves don't have that clarity quite yet. But I think it's getting better.
Does this undermine your confidence in U.S. equities? Does it make you look to, say, Europe? Or does it make you say, well, they will navigate it and it's still the cleanest shirt in a dirty laundry bin, or whatever cliche you want to use?
I think companies in the U.S. will navigate it. There's always going to be ways of adopting and adapting around the supply chain issues. I think with the U.S.-European story, what's been interesting is that Europe has done really well, but the fundamental picture for Europe is not as strong as what we have for the U.S. You're also getting to the end of rate cuts. We still need to see how that fiscal stimulus is going to move through. But the interesting thing is that when we've been doing client meetings in the last couple of weeks, this is across European cities, you are seeing there's a bit more movement in terms of thinking about deals. Right? They're looking and they feel like they have more clarity. They know how to navigate the environment. So there is movement. And I think that at that point, given the valuations are still very much in Europe's favour, you could actually see this continued upturn. I would, just from a fundamental perspective, still prefer the US over Europe.
Seema, just moments ago, Lisa alluded to it, the president indicating that maybe we should move away from quarterly reporting and move to something on a 6-month basis. You follow the stock market. How would you feel about that?
Please don't do that. We need to have that information. If you just think about over the last 6 months or so, the thing that we've all been looking out for is how are these companies trying to navigate tariffs? Are they putting up their prices? Do they feel these kind of problems? If you don't have that information, how can you trade, especially when the economic data itself is so murky? So transparency is really key to trading this market. It's going to be increasingly important as we go forward as well, with even concerns around the Fed and independence. There's just too much which is unclear. That taking away that bit of information is not
You'd
great.
put the emphasis on reducing transparency. Other people might suggest this has been a problem for a while, that corporate management teams are too focused on quarterly earnings and not the long-term goals of the company. Do you think there is some tension on that point?
I mean, there's always going to be some kind of tensions, and you can take it through to certainly to politics as well. And as President Trump said, he compared it to China, which we know has that very long 100-year plan. You can see some benefits, of course, but I think as an investor, what you need is to see that transparency. You need to know exactly what management is doing, how they're going to be performing, how they're navigating the environment. And I think particularly right now in this kind of environment where this is a backdrop, having that bit of information is incredibly helpful.
Seema Shah of Principal Asset Management. Seema, thank you. Appreciate it. This from the President just moments ago. Subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis, but rather to report on a 6-month basis.
I'm thinking a lot about sort of the positive way of looking at this, which is that investors should be looking longer term and companies should be planning longer term. And I would argue that investors have been. Because recently, all of the earnings calls have been really colored by forward-looking views and projections, much more than past-looking performance. We have seen the hopes and dreams of particularly tech companies driving a lot of the performance, not necessarily any potential losses or misses. And I think that that's actually more of a forward look. So I would really wonder what exactly is behind this, right? Especially the comparison and the mention of China.
I mentioned we get on the phone and get hold of Tyler Kendall, and we have done. Tyler Kendall joins us now from Washington, D.C. Tyler, what do you make of that?
Yeah, John, well, to pick up on Lisa's point, I really think the key in this post from the president is his comparison here when it comes to China, since we know that all eyes this morning are really on Madrid as they continue this second day of discussions. And it's interesting because this administration really has had this push and pull with the private sector when it comes to their own tariff plans. Here, President Trump making this suggestion and seeming to allude to this idea that there perhaps needs to be a little bit more of a forward outlook here when it comes to the private sector and their manufacturing plans, and how that could even play into this idea that at the heart of the tariffs we had heard was this idea that there needs to be more reshoring when it comes to domestic production. The other side of this, though, is that the president has taken aim before at those private sector companies when it comes to the projections of their tariff plans. You'll recall when he told Home Depot that he'll be watching, when he threatened Amazon after we had heard that they were going to show that tariff transparency that was later disputed. So it really paints perhaps a bigger picture of both sides of this, John. President Trump putting pressure on the companies amid these talks, but also perhaps giving his idea that he wants to see a little bit more of a forward outlook for his plans and growing the economy.
Tyler Kendall down in Washington, D.C. Tyler, thank you. If you are just joining us, this is the latest just moments ago from the president. Subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis, but rather to report on a 6-month basis. Some breaking news just moments ago. Up next on the programme, the Morning Calls Plus, Tom Narayan of RBC, as tariff headwinds hit the auto sector. Live from New York City this morning. Good morning.
At the moment, if I had to guess, our negotiators are feeling pretty good in that room, that they don't have to give in, that they can keep the status quo, that they can achieve some sort of outcome on TikTok and keep this relationship stumbling along. TikTok is one of those things that has really befuddled multiple administrations.
That was the former Trump White House trade official Kate Kalutkiewicz on the talks taking place in Madrid, Spain today between the United States and China. The equity market this session highs up 0.25% on the S&P 500. The opening bound 1 hour and 14 minutes away. Nasdaq futures positive by 0.2%. That's the price action this morning. Here are some morning calls. First up, Matt Bryson of Wedbush reiterating his outperform rating on Nvidia, noting the strength of AI increasing demand. The stock is down by about 1.8%. Your second call from Citi, upgrading Union Pacific to buy, seeing a compelling risk-reward profile. And finally, UBS, raising its price target on Micron to 185, saying demand from hyperscalers remains robust. The stock is up this morning by about 1/3%. Let's turn to autos. Tesla shares rising in the pre-market as the CEO, Elon Musk, doubles down on his own company. That stock is higher by 7.5%. With the latest, here's Craig Trudeau. Good morning, Craig. What's the latest?
Yeah, this is a roughly $1 billion purchase, which is, of course, couch cushion change for Mr. Musk. But it is a show of confidence in this company at a time when you don't have a whole lot of buy signals, right? You've seen, really sort of disappointing sales data here in Europe in particular. In China, we've seen wholesales continue to really slump, and indications that in the U.S. that their share of the EV market, which is widely expected to go lower as a result of the pullback in tax incentives, that their share of that market is shrinking and continues to shrink. So will they have a stronger third quarter with a lot of consumers in the U.S. market accelerating purchases to try and take advantage of those tax credits before they go away? I think that's widely expected. The question will be, what can Musk do to kind of keep this optimism and maintain this, positivity, even in the face of what he's warned may be a few rough quarters in the months ahead.
Craig, have you got any thoughts on the timing of this announcement this morning?
It makes Tesla's board's job easier selling this, $1 trillion pay package. It sort of reinforces this idea that, if you approve this guy's, $1 trillion compensation plan, it's going to be good for this company. It's going to, get buy-in from him. It's going to kind of bring him back to the fold at a time when, he's, regularly out on social media, oftentimes posting about anything but Tesla. And we saw that even this weekend. So I think it's kind of, this mixed signal. We've not necessarily seen, Musk sort of put his head down and sort of put politics aside for Tesla, aside from, this stock purchase, right? This is a sort of contradictory signal at a time when he's, over the weekend been weighing in on the protests here in London, which are highly charged, and he's drawn some criticism for really charged language. Some say that may have incited violence over the weekend.
The stock is up by 7.5% in the pre-market off the back of that news. Craig, appreciate it. Craig down there, the latest with Tesla. Here's the latest on trade. This from the president just moments ago. The big trade meeting in Europe between the US and China has gone, he says, very well. He goes on to say it will be concluding shortly. A deal was also reached on a certain company that young people in our country very much wanted to save. I imagine that's TikTok. They will be very happy. I will be speaking to President Xi on Friday. The relationship remains a very strong one.
There's a lot to unpack here. The big headline is that Xi Jinping and Donald Trump are going to be speaking on Friday, according to his tweet, his Truth Social post. And there's a real question here around what format that will take and whether it will culminate some sort of agreement. The fact that they got a TikTok deal, is that the entirety of the conversation, or is this kicking off a new parameter for the trade discussions between these two nations at a time where there's still a lot of questions around some of the sanctions, particularly involving Russia?
Perfect time to speak to Tom Narayan of RBC. Tom, good morning.
Good morning.
Great to have you with us. What do you make of this news?
Yeah, I mean, ultimately, we think that all of these tariff discussions are about trade deficits. We used to think that perhaps it was focused on China, but it's actually not just China. Now, that said, there is a fear, right? And you're seeing what's happening in Europe with Chinese automakers and the infiltration they've been having. That's probably going to happen at some point in the U.S. How will it happen? I think the president has said in the past that he'd be okay if it's good for U.S. jobs, perhaps if it's increased production in the U.S., a JV with the U.S. automaker. Probably is how it'll happen. But all in all, I think all of these tariffs are just there for what the president believes is a trade deficit issue.
Even if we manage to remove the so-called barriers to entry, I just wonder how competitive any of the manufacturers in Europe or the US can be in the Chinese market at the moment.
Oh, in the Chinese market? Absolutely. Yeah, that's the big issue. I mean, it's an EV-dominated market. They own the battery ecosystem. It's going to be a while. I think probably you'll have more retrenching, which is not such a big deal for the U.S. OEMs. It's a bigger problem for the European OEMs, right? The German OEMs have such a strong vested interest in China. They have to sell more EVs. I think they have to be okay with losing market share there, but kind of staying in the mix.
Well, there's another question about how competitive U.S. auto manufacturers can be if the tariffs on Chinese goods in particular stay on, right? How important is it for some of these tariffs to come in, especially given that there now are guardrails on Mexico's imports around Chinese vehicle parts and things of that nature as well?
Yeah, that's true. I mean, I do wonder, though, if some of that, the Mexico tariff, 50% tariff, has more to do with a potential deal being struck, right, between the U.S. and Mexico. And we've talked to trade experts recently that seem to suggest that as USMCA gets renegotiated July, perhaps before that, it could actually be advantageous for companies with business in Mexico. But perhaps it's a bilateral deal, or you get some U.S. contenting, which maybe it's a 50% requirement. The U.S. OEMs are already at 40%. It's not that hard to go from 40 to 50%.
You know, Tom, so many people have come on the show and said that there's a greater degree of certainty around tariffs right now, and that now that companies have a greater degree of certainty, they can go out and have greater conviction with their investment plans and hiring plans. You're in ground zero for tariffs in the auto space. Right. Is there certainty? I mean, what have we learned that has given more conviction to the auto manufacturers that you cover?
Yeah, that's a great question. I have to give credit to you guys, Annmarie specifically, for being right on this all along. I think a lot of Wall Street, including myself, probably misjudged it early on. We thought we would have deals across the board early on, and we underestimated the fact that these tariffs are real. I think that does create some certainty, though. At least we know the 15% number. The other thing we know is 15% is the worst case scenario. I think we know it's not going to get worse. The trade experts we spoke to said we're probably going to get carve-outs. We're probably going to get credits, right? Like Volkswagen has talked about making massive investments in the U.S. OEM to government deals that perhaps get offsets where tariffs probably come down. There's a reason why the auto sector has actually traded well in the past recent months. It's because of this certainty. They know what exactly they have to do. GM's making the $4 billion investment in moving the Blazer and the Equinox to the U.S. They're onshoring. So let's not forget, U.S. sales demand, auto sales, is on fire. People forget, like post-pandemic, we didn't buy cars for like 4 years. And we've done our equity research math, locked ourselves in our door and fired up Excel. And you look at scrap rates, you look at labor market, you look at age of fleet, vehicle density. You do all the math and you realize there's a 7 million vehicle deficit. People didn't buy cars all these years. Semiconductor crisis, Russia, Ukraine, the pandemic. Now the demand is still there. So I think that could support these automakers even, with these tariffs.
Is now a good time to move away from quarterly reporting?
How
would you feel about that?
As an equity research analyst, we definitely like the reporting, but I think investors want that as well, right? You can do more, knowledge is cumulative, right?
True.
More data is better than less data.
Tom, appreciate it. Thanks for being with us. Perfect timing to catch up with you, sir. Tom Narayan there of RBC, a fire hose of news in the last 25 minutes. The president suggesting moving away from quarterly reporting and going to something on a 6-month basis. And then this from the president just moments ago, the president of the United States saying he's going to be speaking to President Xi on Friday.
And suggesting that there will be some agreement that will make young people very happy, which, hint, hint, probably is TikTok. As you were mentioning before, a question here around what the contours of this agreement are and exactly what President Trump is talking about. Is it connected, the idea of quarterly reporting and potentially moving to 6-month reporting, or is it just sort of stream of consciousness?
Session highs on the S&P 500.
I don't know. I mean, this
Equities
is
up again.
It's a market question.
Up a third of 1% on the S&P. Coming up, Abigail Watt of UBS with a key Fed meeting just around the corner. Plus, Danny's got your morning movers with Tesla up in the pre-market by close to 8%. The opening bow 60 minutes away. Equities coming into Monday on a 2-week winning streak on the S&P and on the Nasdaq. 8-day winning run on the Nasdaq 100, all-time highs. Up again this morning by 0.2%. With your morning movers, here's Danny. Hey, Danny.
Hey, John, some big news for Tesla this morning. Elon Musk has purchased $1 billion in the stock. That's according to a filing from a purchase on Friday. It also coincides with him getting that $1 trillion reward, or at least that proposed reward if he meets a lot of lofty targets over the next 10 years. So that's about 2.5 million shares that Elon Musk has bought. Those shares moving higher by 8.1%. To the downside, though, this morning, it is NVIDIA, with China finding that NVIDIA violated their anti-monopoly laws. It's a prelim investigation, so more investigations go further. It's around a very high-profile 2020 deal they did over buying a networking gear chip maker. And we also see at the same time, not just a target of NVIDIA, but maybe other American chip makers. Analog Chips, to be specific, China says that they're investigating an anti-dumping law. Those types of chips are made by both Analog Devices and Texas Instruments. So those shares fall by 2.5% and 2.8% this morning, John.
Danny, thank you. Appreciate the update. More from Danny Berger and Matt Miller in about 30 minutes' time for Bloomberg Open Interest to run you into the opening bell about 60 minutes from now. Breaking news this morning came a few minutes ago. President Donald Trump saying he will be speaking with the Chinese leader Xi Jinping on Friday. With the latest, here's Tyler Kendall. Hey, Tyler.
Yeah, hey, John, a pretty big development considering that President Trump also appears to be alluding here that there could be a deal when it comes to TikTok. And I'll point out that we spent weeks earlier this year on this program talking about how President Trump had been waiting for Xi Jinping to call him. But our reporting had repeatedly said that key Chinese advisors preferred to iron out any outstanding details before putting Xi on the phone. So perhaps this could be an indication that they really are getting close to cementing that deal. Now, I'll point out that Xi had called President Trump 2 days before the inauguration, but since then, there's only been one publicly reported call between the two leaders. That happened on June 5th, and China said in their statement afterwards that it was at President Trump's request. The president has, of course, though, previously said that they have had talks, so it's unclear at this point exactly how many times they really have spoken on the phone. But we know that the talks in Madrid have really been laying the groundwork for a face-to-face meeting, and perhaps we'll get some sort of update there. As we know, this White House is aiming potentially for a meeting between the two leaders in person next month, October, at the APEC summit in South Korea. John, I would also just quickly add that we had heard from the president in recent weeks talk about how he's been watching China closely as the leader there has aligned with Modi, the Indian prime minister, and also Russian President Vladimir Putin, inviting them to the country in recent weeks to a security summit. So perhaps this is now President Trump's turn to speak with the leader about those developments.
It's Tyler Kendall with the latest down in Washington. Tyler, thank you. Sneak peek of the price action. Equities near session highs. Meta just down a little bit off the back of the news by, let's call it 0.5%.
Because it really benefited because of the idea that TikTok could be banned, that it would somehow get the traffic. I want to raise a question. If they have a phone call, is it a rotary phone? Is it a cell phone? Hey, Donnie, what's up, G? Or is it going to be some kind of Zoom call? Is it going to be with everybody around them?
No idea.
Is it going to be translators? I mean, I'm curious exactly what the circumstance is going to be for this call.
The prospect of them even having a call is quite remarkable, given what the president was pushing for over the weekend.
And the idea that you could get some sort of contours of an agreement before that call, because Xi doesn't want to get on the phone unless he has a sense of what he's getting into. So I'm curious what he's getting into. I want to understand the contours.
Over the weekend and going into the weekend, the president's pushing the Europeans essentially to put tariffs on the Chinese for consuming Russian crude.
Yeah. So how did things ease in such a significant way? And does this mean that that's off the table? And does this include some sort of other side agreement with Russia? This has been a mind-spinning morning. Can I just tell you, it is exhausting to try to get your head around all of these details and spinning wheels that are going.
I know.
And so you just buy stocks.
Do you remember that breaking news last week about quarterly earnings and moving to a 6-month basis?
It was like a year ago.
30 minutes ago.
It's ridiculous.
Difficult to keep up. Let's turn to the economy. A busy week on deck, with highly anticipated Fed rate decision just around the corner on Wednesday, a statement, a news conference, and Michael McKee some forecasts as well. What are you focused on?
Well, obviously everybody is forecast on the Fed. Lisa's worried about today being crazy. The rest of the week is going to be crazy. We start today with Empire Manufacturing. Normally not an indicator that gets a lot of publicity, but there's a big drop in Empire to negative 8.7. That's a 21-point drop on the month. New orders, shipments, employees, all significantly lower. But the interesting thing is prices paid actually improved a little bit below 50. So we'll keep an eye on what that might mean for the Fed and the overall economy. The Fed is the key thing this week, although before we get there, we get retail sales tomorrow. A lot of focus on that as people try to figure out if the consumer is being hurt by all of this tariff stuff and the other fiscal policies that the president has adopted. Right now, the forecast is for an increase, but not as much as we had seen before. Wednesday is, of course, the Fed meeting. Thursday, jobless claims and Philly Fed. So there are indicators that flow along with this whole tariff and fiscal policy situation that people are going to want to watch, but it's the Fed meeting that will be determinative. The president wants 50 basis points or more. The Fed, at this point, not likely to give it to them. We have some developments to go before we even get there, of course. The Senate tonight expected to confirm Stephen Myron to the Fed Board of Governors so he could vote tomorrow. An appeals court decision on Lisa Cook is anticipated, not guaranteed, but the administration had asked for the right to fire her before the meeting starts tomorrow. The Fed meeting starts Tuesday, 9 a.m. Eastern Time. The Fed decision, 2 p.m. Wednesday Eastern Time. And I know, John, you'll be with us to carry us through all of this kind of craziness.
Or, Mike, I might be around the table at the Federal Reserve. Who knows, given recent developments?
That's true.
You never know. You might be there.
Breaking news, banner.
Michael McKee, thank you, sir. Looking forward to that one. Looking forward to Mike being in that news conference where he should be, asking the hard questions. I'll be right here. Don't worry about that. There's no danger of me being anywhere
I don't
else.
know. Do you have something to tell us? Is this an announcement time?
Absolutely not.
All right, well, keep us posted.
Absolutely not. Retail sales, just to change subject really
Very quickly.
Slipping below the radar a little bit. You've mentioned this a few times already this morning over the last few hours. I wouldn't overlook that, Bryn. I do think it's important. Just what is the state of this consumer? We know we've had this massive step down in payrolls growth. We know people don't feel good about the economy based on the sentiment surveys, but it's how they're spending that really matters here.
How they feel and what they do have been two different things for a long time and kind of counterintuitive over the past couple of years. I'm just wondering, is it still bifurcated? Are wealthier individuals still spending? And Aditya Bahave of Bank of America saying that their card indicators suggest that they are. So how weak is this economy?
Here's the take of Abigail Watt of UBS writing the following. Here's the quote. We expect the FOMC wants to signal a series of rate cuts. We expect a total of 100 basis points of rate cuts this year. Abigail joins us now for more. Abigail, good morning.
Good morning.
This year as in the rest of 2025?
Yes.
OK, quick maths. I'm a simple man. 3 meetings, 100 basis points. You're expecting a 50?
Yeah, so we've been expecting that the Fed would deliver 100 basis points of easing this year since April. So we had, after the Liberation Day tariff announcements, we felt that, we would see it come to the fore that the Fed would have to make this decision essentially between kind of the potential for an uplift in inflation versus the weakness in the labour market. And we thought that would become most acute at this September meeting. And, we continue to expect that we'll see the 25 basis point cut delivered this week. Our expectations for the 50, we do have that penciled in for December. I think our sense is that we continue to see this weakness in the economy persisting. And it's something that, could actually accelerate as we go into the kind of fourth quarter of the year. I think one of the key things, it obviously retail sales, right? I think for us, one of the things that I would note is, you've seen a relatively weak consumer this year, right? You've seen the consumer running below trend so far this year. You saw July popping a little bit higher. So I do think that August print is going to be an important one, just in terms of getting a sense of how this consumer is faring.
So is 2025 going to be a mirror image of 2024 when it comes to 100 basis points of rate cuts into data that only gets better economically?
Yeah, so I think it's interesting because, we are expecting to see kind of more weakness in the labour market side, right? If we remember the kind of layoff program from the federal government side, you've got a slug of around 75,000 workers that are expected to come off the payroll at the end of the fiscal year. So that's going to dent your average, right, through the end of the year. So I do think there are signs that you'll continue to see that weakness in the labour market data. I think the key thing to note here is you've seen that weakness in the consumer, but you've not seen the impact of tariffs yet, right? We're just starting to see some of those price increases coming through for consumers. We saw reports, obviously, from Walmart recently around potentially passing through some price increases in August. So I think that's why we're watching very closely, what's happening in this retail sales data this week, because you've not seen the kind of impact from the tariffs yet on the consumer. You've already seen a slow consumer. So the question is kind of when that kind of feeds through into kind of weaker real disposable income, as you start to see inflation reaccelerating, how does the consumer then respond?
Could you see a jobless reaccelerating? And I ask this given the fact that you've got companies that are investing more in automating different things, creating greater efficiencies, especially in the face of uncertainty with respect to policy. Could you see a pretty sluggish labor market, even as corporate profits expand, even as people continue to spend?
Yeah, look, I think our sense is that we continue to see the labour market weaken through the end of the year, but then we think you will see a little bit of a turning point and into 2026. I think there's a number of things to look to in terms of the potential for kind of a more positive growth outlook through 2026. I just think that the kind of bite of the kind of tariff policies with the inflation pass-through will be felt through the kind of fourth quarter and into the end of the year. Our expectation then is, potentially you start to see some of the kind of fiscal impulse from the One Big Beautiful Bill Act kind of coming through. We should see that, in the April tax refund season. That's something we're watching out for, just to see how that feeds into consumer balance sheets, see how that helps consumers potentially weather some of the price increases we expect to kind of come through.
I have to say, I think that final point is still really underappreciated, because for a lot of people, they view the tax bill as an extension of current policy. Mm-hmm. Can you just sort of build that out for us? Why is that still so important? What kind of refunds are we expecting and why?
Yeah, so I think there's a number of kind of consumer policies around kind of child tax credits. Some of the focus from the campaign around tip income deductions, standard deductions for seniors being boosted. I think there's a number of different elements where you could see that potentially feeding through into a little bit stronger consumption through that period. I think the question is how sustainable that is. I think it would be kind of an impact through the second quarter, say. We have a little bit of a bounce higher in terms of the pace of consumption in our forecast in the second quarter, but then it doesn't necessarily mean that will be sustained. I think the other element that people are watching is obviously what's happening in terms of the investment side. When we look at the investment dynamics in the US just now, we are seeing kind of a very concentrated increase in investment in kind of AI-related goods and not necessarily a broad-based increase in investment. So I think the question is whether some of the extension, as you say, of some of the expensing provisions, does that then feed into stronger investment next year, potentially? We're a little bit hesitant, just given the extent of the response you saw in 2017. But, that's another potential kind of boost that you could see. But overall, we still expect a relatively muted pace of growth next year. We're still below trend. We've got a 1.6% rate of growth next year. So.
Looking for 100 basis points going into year-end of rate cuts, though, from this Federal Reserve. Abigail, enjoyed this. It's good to see you. Welcome to New York. Abigail Watt there of UBS. This from the Treasury Secretary, Scott Bessent, speaking to reporters just moments ago. Some more breaking news for you. In line with what the President alluded to about 15 minutes ago, the Treasury Secretary saying the commercial terms of a TikTok deal have been reached. They've been agreed. The framework for a TikTok deal has been reached over in Madrid, Spain.
Yeah, and setting the bar for the Xi and Trump conversation, Scott Bessent, Treasury Secretary, saying that the two leaders plan to speak to complete the TikTok deal. He appears to be having a press conference alongside Jameson Greer, who keeps talking about the deep respect that U.S. and China have for one another. I just wonder what the parameters are for this deal to get done. Is there broader ramifications for other aspects of some of the trade negotiations, or was this highly isolated to just this one company and what terms it can keep operating in the U.S.?
It's been quite a 40 minutes for news, that's for sure. On that front, on quarterly reporting, and this from the President just moments ago as well on the Federal Reserve. Too late, must cut interest rates now, and bigger than he had in mind. Housing will soar. The President of the United States just moments ago. We'll put this all together for you in the next 5 minutes or so. Let's get you a news wrap with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump is out with a new proposal for Wall Street. Trump posting on Truth Social, quote, subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis, but rather on a 6-month basis, adding that China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis. He added, not good. The president also posting about the trade talks with China, saying they are going very well. He also hinted they had reached a deal on TikTok. He didn't mention the company by name, but said it was a certain company young people wanted to save. And Secretary Bessent also alluded to that just earlier. Trump adding he'll be speaking to President Xi on Friday. And New York Governor Kathy Hochul has endorsed Democratic nominee Zohran Mamdani for mayor of New York City. Hochul wrote in a New York Times op-ed that she is confident Mamdani has the courage and urgency New York City needs. Trump slammed the move by Hochul amid his flurry of truths this morning. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead, get you the latest from Madrid, Spain, and then speak to Greg Peters of PGIM Fixed Income, looking ahead to the Federal Reserve and getting his reaction to developments on trade from New York City. This is Bloomberg.
There'll be guidance because they're going to publish the summary of economic projections. I think the big debate there is, do they show one more cut after September, or do they show two more cuts? And I think it's going to be a very close call between those two outcomes.
We know what this market's looking for. Two more cuts after this cut this week and a whole lot more into 26. That was the former New York Fed President, Bill Dudley. This market is near session highs, up by 0.3% on the S&P 500. On the Nasdaq, up by 0.2. The opening bell about 42 minutes away. And in focus is global trade. New updates from Treasury Secretary Scott Bessent and US Trade Representative Jamieson Greer. The two looking to wrap up a second day of talks with China in Madrid, Spain. With the latest, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Hey, John. So the Treasury Secretary Scott Bessent telling reporters in Madrid that President Trump, Chinese President Xi Jinping will wrap up the final details when it comes to a deal on TikTok. And it really is just in the nick of time. Wednesday is an important date around here for a few different reasons, but it is also the deadline for a deal on TikTok. So this likely means that President Trump is going to extend it a little bit further so that they can get the implementation underway. Now, we're still waiting for what this deal is going to look like. But I'll point out that we had reported earlier this year that the U.S. was aiming for a new U.S.-based version of TikTok, owned and operated by a majority of American investors, and that the goal was to have ByteDance's holdings reduced below 20%. As we wait for these details, one thing is going to be for sure. We're going to be looking for what those data user security guarantees are going to look like, because at the heart of this really does cap off, at this point, a years-long battle after we saw U.S. lawmakers pass this law banning TikTok over these national security concerns. We know the White House has been deeply involved in this after really flipping President Trump's position. Used to be against this, but since we've heard him really talk about, John, the appeal of young voters on this platform, and that seems to help spur this along.
Tyler Kendall with the latest down in Washington, D.C. Tyler, thank you. Concluding remarks coming out of day two of talks in Madrid, Spain on TikTok, of all things. Not the breakthrough that many people in the market were hoping for.
No, they were hoping for some sort of larger framework for trade, especially in light of Russia. I will just note, it's fascinating to see the market reaction to this. You put it to Meta, shares just slightly lower with this idea that they were going to benefit potentially from TikTok getting banned. Oracle shares up dramatically in pre-market, and this comes after Larry Ellison was one of the rumored members who could be involved in bringing TikTok to the United States. So interesting to see those shares up 4% in pre-market.
I won't speculate. I'm sure you're not keen to either. But of course, this was something that came up in the president's first term over the same issue, TikTok. Do you remember that one?
I do.
It was Oracle, Walmart in the mix as well.
Yep.
Odd mix of companies at the time.
It's just interesting to see how much markets are moving on this. And if you want to watch for another move, just wait and watch Truth Social.
That stock had a massive week last week. Oracle up this morning by 4%. Looking ahead to the rest of this week, Greg Peters of PGIM has this to say. US macro base case is a muddle through. While downside tails remain, there is a chance of a mild recession. We see limited crash risk. Greg joins us now for more. Greg, welcome back. I'd love an update on where you are now, because the last time we spoke, you talked about the risk of a repeat of last year. The Fed was going to cut and maybe the long end sold off. We've started to see some stability return to the long end of the curve, Greg. Do you take some comfort from that?
Yeah, there's definitely been a reversal. The steady, unrelenting kind of steepener trade kind of reversed itself over the past week or so. But I'm not convinced that that is kind of how it's going to continue to play out. You know, I still think the risk in the system is for steeper curves, not flatter curves. You know, you look at kind of where we are economically. You have, just talked about, the fiscal lift that I think you'll see. You'll see more monetary stimulus. You're seeing the effects of tariffs come through. You see a lot of, kind of the breaking down of institutional norms, all these types of factors, I think will lead to more pressure on the back end. At the same time, though, everything will get pulled down. The question is, how will the back end kind of get pulled down with it? Will it be 1-to-1 or kind of 1-to-1/2, that sort of ratio? I just don't know.
This is something that we've been talking about here. How much is this just crowded positioning getting stomped out in terms of the yield curve flattening? I'm just wondering about the reaction function to Wednesday's announcement. If there is a real dovish bias to what the Fed does, do you see that curve steepening reinstating itself, or do you think that right now the market's just in a different frame of thought?
I think the answer is both, Lisa. So I do think there's an expectation that the Fed will just do 25, but, I don't think anyone would be completely shocked by, a more dovish bias here. that's where the markets are leaning. So that should largely be in the price. But I think it's important to note that the inflationary effects haven't really come through yet, from a tariff standpoint. And then if in fact this administration and this Fed is trying to kind of goose housing, then that's the area that has actually pulled down inflation, right? It's been a disinflationary environment on the housing front. So if you kind of do programs and policies to reignite housing, that should, all else equal, put pressure on the back end of the curve.
So what do you like right now? Are you just going into high yield bonds and cash?
Well, we like what we continued to like all along, and that's kind of the safe carry trade. So I think economically, the environment's in pretty decent shape. There is this risk that you can actually overheat in here, just given all the policies we just talked about. But for me, as a credit investor, I just don't see a lot of value, right? Credit spreads are pretty tight. So the bet that you're making to be really long credit in a beta way is that you have to go through all-time tights, which is a heroic bet in my mind. So it's about safe carry, kind of front to intermediate part of the curve. And I still think the back end of curves are quite susceptible here.
Greg, before you go, I'd love your response to this. It just came in from Neil Dutta of Renmac, just sent me a message and said the market has the Fed going to neutral 2 years before the Fed has it. They can't meet those expectations. Greg, would you agree with that? Is that the risk into Wednesday?
Yeah, but I think that's kind of a persistent risk, right? Markets always are ahead of where central bankers, tend to be. So I don't think that's a complete shock. You look at 1 year forward, you kind of have a 3%, which is, quite in the neutral range, if, even maybe a little lower than neutral. So I think get to neutral, see how the economy responds. The markets have a tendency of getting ahead of itself. Par usual, and I don't think this is any different this time around.
Greg, thank you, buddy. Greg Peters of PGIM. Catch up with you later this week, I think. Greg Peters of PGIM Fixed Income there on the Federal Reserve into that decision on Wednesday. What a 60 minutes this has been. Concluded remarks from Madrid, Spain on the second day of trade talks between the US and China, a push to move away from quarterly earnings from the President of the United States to something on a 6-month basis, and maybe some kind of outcome with TikTok with very little detail.
And the headlines keep coming. So Treasury Secretary Scott Bessent speaking to reporters, this headline just crossed, they discussed the poor timing of the NVIDIA investigation. That was how he framed it, given the fact that China has come out about potentially anti-dumping laws and anti-monopoly laws. This is a very active administration and a very confident market, and that seems to be the contradiction here.
This from Jameson Greer, suggesting the US is open to action on extending the truce with China. Just keeps being extended. Coming up tomorrow, Henrietta of Deutsche Bank, Sarah House of Wells Fargo, Monica Guerra of Morgan Stanley, Alicia Levine of BNY Wealth. From New York City this morning, good morning. This was Bloomberg Surveillance.